which Lally should report on 31st December 2005. Okay, so first of all, we will see 2004. Sessions, we have done multiple choice questions on Hello everyone, welcome to the lesson on deferred taxes and multiple choice questions. In the previous sessions, we have done multiple choice questions on deferred taxes, and here is one more question which I felt should be explained because it has a lot of concepts to be learned from this question. So let us go to the question. I would suggest that you pause the recording. Try to do it by yourself, and then later on look at the explanation. So it says that there is a gain of 80,000 for the sale of real estate. And 2004 financial statements or income statements includes that gain. Okay, so this income before taxes includes that gain of 80,000. For which Lally financed the sale on a short-term note. That means he received this money with a short-term note, and the company received it fully from the buyer in 2 installments during 2005. And reported the gain on its 2005 income tax statement. Okay, income tax return. So he did not report that gain in 2004 income tax return, but when they received it, he has reported that gain. Okay, and it was like an installment sale, so they got it in 2005, and he paid tax on it. He was subject to a 40% tax in 2004 and 2005. What is a deferred tax asset or liability which Lally should report on 31st December 2005? Okay, so first of all, we will see 2004. I'll take it as 2004, though it's X here, can take anything. So in the financial books, income is 4 million. I'm truncating the zeros. Okay, and interest income included above that was not subject to tax. So in this, interest income is also included, which is not subject to tax. So the tax now it's going to be at 40%. What is going to be the tax? This has that 80,000 as well as that 100,000. So the tax, so this is a permanent difference. This is not subject to tax at all. So when you calculate the tax, you're going to minus that 100. So you'll calculate tax on 3,900, not 4,000. However, that 80,000 would be taxed. So it should be included to calculate the income tax expense. Okay, so 3,900 into 40% would give us 1,560, and they would report in the financial statements 2,440. So 4,000 minus 1,560, 2,440 would be reported as income after tax in the financial books. Now in the tax books for 2004, tax from this 4 million, 100,000 is deducted because it will never be taxed. And 80,000 gain also is deducted because he has told it will be taxed when they receive it in 2005. Okay. So they would pay current tax of 4,000 minus 100 minus that 80. He would pay it on 3,820, and 40% tax on that would be 1,528. So the entry would be in 2004, credit tax payable with the current tax which has to be paid 1,528. Since the tax expense is going to be the same in 2004 and 2005, we can debit income tax expense what is reported in the financial books, 1,560. The liabilities are short by 1,528 minus 1,560. A 32,000 deferred tax liability would be reported in 2004. Okay. So now they are asking for 2005. Please remember that in 2004, a deferred tax liability of 32 would be reported. Okay. See, they can ask you many things in this question. They can ask you what is the income after tax in the financial books, for which you will write 2,440. What is the income tax expense? When they say what's income tax expense is as per the financial books, it is 1,560. What is the current tax payable? If they say it is 1,528, or sometimes what is the current tax expense? They would ask. Again, it will be 1,528. Total tax expense is 1,560. So they can ask you so many things in this question. So now remember, remember that in 2004, we have a deferred tax liability of 32,000. Now we will remove the whole thing and show you 2005. And I'll show you how that DTA will get reversed. So in 2005, financial books, you are having 5 million. I'm truncating the zeros again. This is the income before tax, right? Income before tax. And then you will be taxed at 40%, but it again includes 100,000. This 5 million includes 100,000. So you will calculate tax only for 4,900 because the 100,000 would never be a tax expense because it's exempt. So the tax is going to be on 4,900, 40% will be 1,960, and after tax, it's going to be 5,000 minus 1,960, 3,040. Now 2005 tax books. You would actually include this, but exclude 100,000, which is not going to be taxed at all. And you would add 80,000 because this one doesn't have that 80,000. 5,000 doesn't have that 80,000, but this is because they received the money. So that gain will be taxed, as he told, in 2005 returns. Okay. So the taxable income would be 5,000 minus 100 plus 80. 4,980. It would be taxed at 40%. Would be 1,992. So this is the current tax. So credit tax payable, what we have to pay as per the tax returns. Debit tax expense as per the financial books. The difference is short on the debit side. So you would debit, actually it's a deferred tax asset, but we have a deferred tax liability from 2004. And that would be debited 32. Now debit and credit tallies, it agrees, right? So this is how the deferred tax liability would get reversed in 2005, which was there in 2004. If you remember, we had reported a DTL of 32,000 in 2004, which gets reversed in 2005. And therefore, the DTL would be 0. So there's no deferred tax asset or liability reported. So D would be the right answer because the deferred tax liability gets reversed in 2005. So this gives you an idea how the whole thing works. Okay, and as I told you, they can ask you any question. If they ask you income tax expense or total income tax expense is as per the financial books 1960. If they ask you the current tax expense, it is 1992. Okay. If they can even ask you what is the taxable income in 2005. They can ask you so many things in this. Okay. So better have a complete picture of this whole question. Okay. So that's about the multiple choice question. So let us go to the next topic, which is carry forward of losses in the next video. Hello, everyone. Welcome to another session on deferred taxes. And this time we are going to talk about carry forward of losses. How are carry forward of losses treated? How is it accounted? And how is the income tax benefit on that accounted? All that will be discussed in this lesson. First of all, let me go to the text. There is a note, or there's a description how the treatment of net operating losses, sometimes called NOL, just like this. Okay, so how's the accounting done in the past and the present? Everything is given here. And also they speak about a valuation allowance. Okay, so that also is dealt with here. So what I would do is, and what I would suggest you to do is, first listen to my explanation. Okay, I would show it to you with a simple example, and then do a reading of this, and it would make more sense then. Okay, right. So let us go to the whiteboard, where I'll be explaining with a simple example. So let us assume 3 years, year 1, year 2, and year 3. Okay, and let us say year 1, there is a profit of 100,000. Truncate the zeros. Okay, 100,000. Year 2, there is a loss of, let us say, 200,000. And year 3, there is a profit. Year one, there's a profit of 100,000. The loss is in brackets. And year two, a loss of 200,000. And year three, let us say a profit of 200,000. Okay. Let us say all years the tax rate is 40%. There's no change in tax rate. Okay. So now, this would give us a tax benefit, in fact. So this loss would be giving us a tax benefit of 40%. 40% tax benefit is going to be, as you know, 2 4s are 80. So 200 into 40% would give us 80. Now, I'm not going to put 80 in brackets because it's a benefit. Okay. And the loss after taxes, this is all in the financial books. The loss after taxes is going to be 120. It's going to be lesser because of this tax benefit. Okay. Now, previously, now see here, the company would have paid a 40% tax. And reported a 60. Previously, we could carry backward. We could also carry the loss backward and claim an income tax refund. Even now it's available, but only for farming industries and I think insurance industries. But it's no longer allowed for any other companies. But a carry forward facility is allowed. So you can carry forward this loss for any period of time. Okay, so that's the advantage. Previously, it was restricted to 20 years, but now you can carry forward the loss for any period of time, but carrying backwards is available only for a few industries. Okay, so we'll not go into that details because carry backward will not be tested. So only carry forward would be tested. Okay, so that would be, you can carry forward it for any period of time, but subject to a 80% limitation. Now, what's all this about? First of all, in the year of loss, the deferred tax asset is booked. So it would be debit DTA, deferred tax asset, of 80 and credit income tax benefit from carrying forward. Okay, that is 80. Right. So in this year of loss, a deferred tax asset is booked. Now let us see how it works out to offset the future taxable income. Now, these losses can be carried forward to offset future taxable income. Now, let us say in year 3 for financial books, 200 should be taxed at 40%, which is 80. This is a tax expense, and you should report a 120 after tax profit. Okay. Now, in year 3, tax books, you will report this 200, but this loss can be set off against this taxable income. But subject to the 80% limitation. So how much can we cannot set off the entire 200 like this. Okay. Previously we could, but now we cannot set off the entire 200 like this and pay a zero tax. Okay, because the taxable income is zero. There is a 80% limitation. Now, what is that 80% limitation? That 80% limitation is 80% of that year's income. That is the limit for which you can carry forward the loss. Let me just show it to you to make it more clear. So 80% of this would be 200 into 80%, which is 160. So you can carry forward from here only 160. Only 160 and not 200. Okay, only 160 the loss can be carried forward. This is to ensure that the companies pay at least some tax and do not go scot-free without paying taxes at all. Okay, so that would now bring the taxable income. So we are offsetting this year 2 loss to the extent of 80% of the current year's taxable income. Okay, so that's the 80% limitation clause. So 200 minus 160 would give us 40. Now 40 is taxable at 40%. So that would be 16. 40 into 40% is 16. So what will be the entry? The entry is going to be credit tax payable, current tax payable 16. Debit tax expense, because strictly speaking, that should have been the expense 80, right, for the taxable income, right? And credit deferred tax asset. Now see here, we are realizing the deferred tax asset, the difference, which is 64. So now the deferred tax asset account which had a 80 debit in year 2 would get realized in year 3 by tax expense tax expense, it will get realized 64 right? And we would have a balance to yet to be realized is 80 minus 64, which is equal to 60. This should be the balance in the deferred tax account, yet to be realized. Okay, so that is how we account for it. That is how we account for it. Okay, so the deferred tax has come to, how is it caused? It's caused by the difference in the taxable income between financial and tax books. The difference is 160, and 160 into 40% is this 64. Okay, I hope you understood how it is realized. And then 16 is the benefit to be realized in the future years. So this is the concept of carry forward of losses and the 80% limitation clause. Okay, now regarding the valuation allowance, now you have a DTA in the non-current assets, because all deferred tax liabilities and assets are classified as non-current. So now let us say you have 16 here, and you have no hope of getting the benefit of it because you don't foresee a profit in the future years. Okay, there's going to we imagine there's going to be only losses. So in that case, you cannot, you don't have any profit to offset the loss. Remember, still we have to offset 40 loss. Okay. So that 40 loss, because we have offsetted 160. Still 40 remains. So suppose if you don't have any future income or no hope for it, we create a valuation allowance debiting tax expense in any year when we feel we cannot realize this deferred tax asset. Debiting tax expense 16 and crediting a valuation allowance, just like for bad debts, 16. This valuation allowance would be a contra asset and will report a 0. And later on, if we really cannot realize it, we would write off this deferred tax asset by debiting valuation allowance for carry forward of losses 16 and will credit DTA 16, just like we write off an unrecoverable accounts receivable. Okay, so it would be presented like this, the valuation allowance, when it's more probable than not, meaning there's more than 50% chance that we may not recover this deferred tax asset. So that's the time we create a valuation allowance. And eventually, when it becomes sure that we are not going to get the benefit of this carry forward loss of 40, we would write it off in this manner. I hope those concepts are clear. So now let us just go to the text. If you do a reading of the text now, it would make a lot more sense. Okay, so he talks about the 80% limitation here, right? He also talks about the 2-year carry back, which was permitted before, but now it's only permitted to farming and also, I think, for insurance company. Okay, but now it's no longer allowed for other companies. But then the net operating losses can be carried forward indefinitely. Okay, so anytime it can be carried forward indefinitely, but it is subject to this 80% limitation. Okay, so that here mentioned, you can do a reading of that. It'll be more clear. And also the valuation allowance, okay, which I told you about. I told you the entry also. If the management expects that they can recover or get the benefit of the deferred tax asset or the future carry forward loss benefit, if they feel that they will be able to get the benefit of the carry forward of losses, then the valuation allowance is obviously not needed, right? They can offset it against future taxable income and get the benefit. So this is about those concepts. I will search for a question on carry forward of losses and show it to you in the next video session. If I don't get it, we'll go to leases. We will discuss leases. Hello, everyone. In the previous session, we spoke about carry forward of net operating losses. I explained the concept, and in this session, we will do a question on that, especially testing the 80% limitation clause. So this is the question. So the company N Corp reports a net operating loss in year 1 of 20,000. In year 2, the company reports an income of 10,000. What amount of year 2 income may be offset by the carry forward of year 1 net operating losses? Now, let me show it to you in greater detail. So, year 1, they recorded that 20,000 loss. And year 2, a profit of 10,000. Okay, year 2, a profit of 10,000. Fine. So now year 1, they would record, well, he did not tell us the tax rate. Okay, he has not told us the tax rate because it's not required in this question. Okay, so how much would be the amount of year 2 income that may be offsetted by the carry forward of year 1 operating loss? You might think that I told you that losses can be carried forward indefinitely. So can we take from this 10,000 loss offset against year 2 income and pay no tax because of no taxable income? No. The 80% limitation clause does not allow that to happen. Okay, so what does it do? It won't allow that to happen. So year 1, the loss is 20,000. It's limited. The carry forward of loss is limited to 80% of year 2 income. So that is equal to 8,000. Okay, so what amount of year 2 income may be offsetted by the carry forward of year 1 loss? So this you can only take from here, not 10,000, but 8,000. Okay, so another 12,000 is available now to carry forward further. Okay, so you will pay tax for 2,000. So what amount of year 1 income may be offsetted by the carry forward loss? 8,000 of it. Okay, so B is the right answer. So this is that 80% limitation clause. Okay, so this is how we would apply it to an MCQ. So with that, we finished deferred taxes, all the concepts, temporary difference, permanent differences, carry forward losses. Okay. And in the next session, we would discuss leases. Hello, friends. In this session, we are going to start a new lesson, leases. Okay, so I will first explain it by going through the text, and then I will show you a demonstration of it. Okay, so let us go to the text first. And accounting for leases is actually all on the balance sheet now. Previously, it used to be off balance sheet. The operating lease is to be off balance sheet. Now it's all on the balance sheet. Okay. So the lessee, the person who takes the equipment or asset on lease, should recognize assets and liabilities that arise from the lease. Okay. So the asset will be in the form of an intangible, actually, a right of use asset. Okay. And a lessee should also recognize liabilities over the lease payments, over the lease terms, to the amount of the present value of lease payments. Okay. And in a finance lease, the lessee would, even in the operating lease, the lessee would amortize the right of use asset, and each payment made by the lessee would include interest payment and a principal payment, which is basically the lease liability, right? All right. So it's analogous to the principal balance of a loan. Okay. Now, what's the definition of lease? I am sure most of you all know it. There is a lessor who would actually give out the asset on lease to the lessee. The lessee would pay the lease rental and take control over that asset. Okay. So basically, control means substantially all the economic benefits of the use of the asset and the right to direct the use of the asset as well. So there are two categories of lease. Now, this part is important, and this is what it will be tested in the exam: the finance lease and the operating lease. Now, it will be categorized because the accounting is slightly different for a finance lease and operating lease. So to be categorized as a finance lease by the lessee, one or more of the following criteria, even one criteria of this, if it's followed, it is good enough to categorize it as a finance lease. You'll be tested on these 5 conditions. The lease transfers ownership of the underlying asset to the lessee by the end of the lease term. That means if by the end of the lease term, the lessee gets to own the asset, then it will be like a finance lease. Finance lease basically would treat the asset as if it is the lessee's own asset. Okay. And the lease grants the lessee an option to purchase the asset, which he cannot refuse. Okay. And he would certainly exercise that, meaning it would be much less than the market price. The lease term is for the major part of the remaining useful life of the asset. Okay, unless the asset falls, the lease falls near the end of the economic life of the asset. But the major part, what is major part is very relative, but US GAAP would explain exactly how much is major. Okay, I'll come to that in a moment. Then the present value of sum of all these payments and any guaranteed residual value. What's the meaning of guaranteed residual value? Something the lessee has to pay in the end. Okay. By the lessee not already reflected in the lease payments is equal to or greater than substantially all of the fair value of the underlying asset. That means the present value of the lease rentals would be so much that it is very close to the fair value of the asset. Okay. How much is substantially all? We'll come to that in a moment. And the underlying asset is of a specialized nature that only the lessee can use it, and the lessor would not have any alternate use of that particular asset. So in other words, it's sort of custom made for the lessee. If one of these conditions are satisfied, the lessee would categorize this as a finance lease. Now, how would you remember this? Okay, I would give you a way to remember. I believe it's called mnemonic, right? A memory aid. Rather, I will give it to you. With the help of that, you can easily remember these 5 conditions. Okay, so first of all, the major part of the economic life of an asset would be 75% or more. And substantially all of the fair value, what we saw here, right? Both this major part is 75%. And substantially all part is 90%. 90% or more of the fair value. If the present value of future payments, lease payments, is equal to or greater than substantially about 90% of the fair value of the asset, it should be categorized as a finance lease. Now, for those memory aids. So, if the lease transfers ownership, right? So let us remember ownership. So that is transfer of ownership would be one of the conditions at the end of the lease term. Okay, so that would be one of the conditions. Then there's a purchase option. Okay, so the lease grants the lessee a return bargain purchase option. This purchase option is also called return bargain purchase option. What is a bargain purchase? The option to purchase it below the fair market price or fair value would be a bargain purchase. I told you, this the lessee cannot refuse. It is so lucrative for the lessee that he is going to buy that asset by the end of the lease term. Okay, you cannot resist it. So that return bargain purchase, that W of the return, we will use as a memory aid. And then let us talk about this condition. Okay, so the present value of the sum of all the lease payments and any residual value will be equal to or greater than, I told you, 90%. 90% of the fair value of the asset. So this one, I put it as N, own. Okay, so present value of all the lease payments would be very close to the fair value of the asset. So he's actually literally purchasing that asset. Okay. So that is 90% of the fair value of the asset would be the sum of all the present values of lease payments. And then, as you saw, the major part of the remaining useful life of the economic asset, the major part is termed as 75% of the useful life of the asset. What does it mean? It means if the lessee is going to take on lease an asset for 75% of its useful life, he's literally taking it for almost its entire useful life on lease. So he's like literally owning it, right? So that would make it categorize as finance lease. Okay, so this 75% of the major part of that is the major part of 75% or more of the major part of the economic useful life of an asset, that would be S. So now we got owns to remember. Ownership transfer, return bargain purchase, 90% of fair value of the asset would be paid. Okay. In other words, the present value of all the lease payments will be equal to 90% or more of the fair value of the asset, and the asset is taken on lease for 75% or more of the remaining useful life of the asset. Now, for example, if the asset has got a 10-year useful life and the lease period which the lessee takes it for is, let us say, 8 years out of this 10 years, it's more than 75% of the useful life of the asset, is it not? So that's what they mean here. So we got the memory aid for this, owns, but there's one more here. The underlying asset is of a specialized nature and has no alternate use. Okay, so there's no alternate use. So I will take this own sa. Okay, this A is for there's no alternate use. Okay, so you can remember the memory aid own sa. If one of these conditions are satisfied, then you can categorize it as a finance lease. Now, for a revision, what is O? You should be able to tell. Ownership transfer at the end of the lease period. What is W? A return bargain purchase option which the lessee cannot refuse, right? What is N? The present value of all the lease payments, okay, discounted at a particular rate. I'll come to the rate which you will discount it later on. So present value of all lease payments is 90% or more of the fair value of the asset. And what is S? The asset is taken on lease for 75% or more of the estimated life of the asset, right? Right. So substantially all the life of the asset, right? And what is A? There is no alternate use of the asset for the lessor. It is like a custom-made asset for the lessee. So if one of these conditions, if one or more, even one is sufficient, if one of these conditions are satisfied, it will be categorized as finance lease. Now, how do you account for a finance lease? We'll come to that in a short while. Okay. Then, if none of the criteria of the finance lease are met, the lease would be classified as an operating lease. Now, what is an operating lease? Okay, I'll come to this later, this part later. Operating lease is if one of those, if not even one of those conditions are satisfied. Okay. But still, you would have to bring it on the balance sheet. Fine. So we'll come to the accounting part of it, right? This accounting part of it, how a right of use asset is recorded, okay, and how the accounting entries, what is the rate implicit in the lease, okay. Let's say incremental borrowing rate is sometimes used to discount cash flows, right? All these theory, what is given here, I would show it to you in a form, in an Excel with an example. That would be very clear for you to understand this concept. And after that, you can read the text. It would make much more sense. I would advise, do not read the text before you see my example, because it would be more difficult for you to understand. Okay. See my example, which I will do in the next video. And after that, read the text. There's also short-term leases which will not come on the balance sheet. Operating lease and finance lease will come on the balance sheet. But short-term leases are leases taken for 12 months or less. You would just expense the lease rental for that on a straight line basis. It will be an equal lease rental over the lease tenure. And that's it. You will not record an asset. You will not record a liability. It is an off-balance sheet item. A short-term lease of 12 months or less is a off-balance sheet item. It will not come on the balance sheet, but the expense will be recognized. Lease expense will be recognized in the income statement. So that's the theory. The theory is, that is all. Okay, then we'll go to the next lesson. But however, it's not complete unless I show you a demo of how it's all accounted. Okay, I will show you finance lease and operating lease side by side so that you can make a comparison and it will make more sense. And that will be in the next session. Hello, friends. In this lesson, we will look at a demonstration of finance lease and operating lease with an example so that you can understand that concept. When you read the text, it would be more clear once you see this demo. So let me go to an Excel sheet. Right. So now, if you remember in the last video, I had told you about how to remember those 4 conditions, right? 4 or 5. 1, owns. Owns-a, right? So it is 5 conditions. Ownership is transferred at the end of the lease period, then it will be characterized as the finance lease. Basically, when the lessee almost owns the asset, that is when it will be categorized as a finance lease because he would also be recording amortization expenses. Okay. And then there's a return bargain purchase option, which the lessee cannot refuse. He will buy it. And the present value of all lease payments including the guaranteed residual value, what the lessee would have to be paying in the end, would be 90% of the fair value of the assets. Okay. And the asset is leased for almost all of its economic life, which is 75% or more of its economic life. If the asset is leased by the lessee, then it will be a finance lease. And the asset does not have any alternate uses to the lessor. That means it's sort of custom built for the lessee. Then it will be a finance lease. Now, for this example, I've assumed a rental of 57,619. The life of the asset, I would assume it to be life in the finance lease part is to be 2 years. And he has taken it on lease also for 2 years. So then out of the owns, the S part is satisfied. That is, it's taken on lease for substantially all the life of all of the useful economic life of the asset, right? So here it should be 75% or more, but it's almost it's taken for 100%. Life is 2 years of the asset and he's taken it for rent for 2 years. Okay. So that S part is satisfied. So it will be finance lease. Now, you saw in the text a rate implicit in the lease. So now this rate implicit in the lease should come from the lessor. The lessee would not know it. So if he doesn't have this, if the lessee doesn't have this implicit rate, then he would discount the cash flows with the lessee's incremental borrowing rate. Okay. Now, how is the rate implicit in the lease calculated by the lessor? For example, let us say the lessor has purchased the asset for $100,000, which is giving it on lease for 2 years. So he's minus 100,000. The investment is 100,000. Then he gets these 2 lease payments, right? Year after year. What is his rate of return? That is the rate implicit in the lease. So the internal rate of return. So we can get it by IRR. Okay, so this is the internal rate of return. Right? Right. If I put a percentage, it's 10%. So the rate implicit in the lease is calculated in this way by the lessor. Okay. And actually, we were in my company was a lessor for this for some material handling equipment, and we used to calculate many finance lease deals were there. So we used to calculate the rate implicit. Being the lessor, we used to calculate the implicit rate in the lease just in this way. Then after that, we have to capitalize the lease. Now all these entries are in the books of the lessee. I'll put there, not the lessor. We are not studying so much about the lessor's books here. Okay, so lease is a very small chapter in CMA, but we should know all aspects of it. We cannot go with half-baked knowledge. Okay, so all in the books of the lessee. Now with this implicit rate, we would discount the cash flows. Okay, so how do we discount it? At 10%. So I'm going to use the formula to discount at 10%, absolute reference rate, to the power of, you can also use present value tables and discount it at 10%. 57,000 will be 52,381, and then it would be 47,619. The total of it would be 100,000. If you notice, the total of this would be 100,000. Okay. Right. So once we have discounted it, With this value, we would record, the lessee would record the right of use asset, which will be on the asset side, and a lease liability, which would be on the liability side of the balance sheet, right? With present value of all future lease payments. Then, in order to pass the entry, the lessee would prepare a lease amortization table, wherein the first column has got, I'll bold it. The first column has got lease years, lease payment, interest. Okay, 1 second. Off. Yeah, so that everything will be seen. Yeah. The lease payment in the second, interest will be the third column, amortization of the lease liability, which is something like paying off the principal, and the balance in the lease liability. Remember, the lease liability is 100,000. So the year 0, only the balance of lease liability is there. There is no amortization. Okay. Lease payment. How much is the lease payment? This one, 57,619. That's what I have assumed. Okay. $57,619. Okay. What is interest? Interest will be 10%, because that is the rate implicit in the lease. So 10% of the lease liability would be accounted as interest. Because you see, ultimately, you're paying more than the fair value of the asset, is it not? If I calculate this, the sum of this, it is more than the asset cost for the lessee. What's that remaining he's earning? He's earning interest, basically. Okay. So the interest would be 10% on this, on the balance of the lease liability. So 10% of that, I just put it like this. Absolute reference this. Yeah, 10,000. The balance, that is 57,619, the lease payment minus the interest, would be amortized. This is the amount which the lease liability will be amortized. And then, right, it's not exactly called lease liability amortization. I should call it, instead of amortization, I should call it payment towards lease liability. Okay. Payment of lease liability, we'll put it that way, which is basically analogous to the principal payment. Okay. And then what is the balance of lease liability after that? It was 100,000. 47,000 is allocated to reduce that. So the balance would be 52. Then next year again, they would pay this rent. The interest is going to be is going to be 10% of the balance of the lease liability. How much is that? It would come to 5,238. Okay. So it is actually it's calculated on the balance. Okay. Once again. Yeah, it's calculated on the balance. Fine. So that's it. And then what is allocated towards the principal? That is the lease liability. That is the lease payments minus the interest amount is allocated to the lease liability. And now lease liability becomes zero because this would be reduced by the allocation here. It would be zero. So this is how the amortization table is made. Now, how about the first year entry under finance lease? You would debit lease liability with the amount here, 47. So that is what is going towards payment of lease liability. So 47, 619. Debit interest, which would go to the income statement. Okay, interest on lease would go on the income statement. That 47,000 would go to the balance sheet to reduce the lease liability, and cash credit, the sum of both of that. The sum of it, which is nothing but the amount of lease rental. That is how the lease rental is paid, right? Then we would record amortization expense. We have a right of use asset, is it not? So it has to be amortized. So what is the recorded value of the right of use asset? 100,000. We'll amortize it on a straight line basis over 2 years. That is 50,000. So 50,000 and right of use asset credit 50,000. These are the entries for the first year, right? I'll come to operating lease after that, but first let us look at the finance lease, right? So these are the entries of the first year. Amortization expense is also recorded. So what's the charge to the P&L in the first year? Instead of 57,619, like it would be for an operating lease, it would be these two amounts, which is 60,000, the interest and the amortization expense. That would hit the income statement. How about year 2 entry? Year 2 entry, ready cash. Would be the same, but the figures would be different. the lease liability would not be 47,000 now. It's going to be 52,381. Okay, the lease liability second year will be 52,381. And what's the interest? Interest is not going to be 10,000. It's going to be reduced amount, 5,238, because it's calculating on the balance of the lease liability. And what's the cash outflow? It would amount to the rental. It should amount to the rental. Yeah. Yes, it's amounting to the rental. Lease rental. Amortization expense, same as the first year, because it's straight line basis. Debit 50,000 amortization expense and credit right of use asset. So by the end of it, the lease liability, which is 100,000, credit, would get two debits here in year 1 and year 2, and it would become 0. The right of use assets, which was recorded at 100,000, would also become 0 with amortization expenses recorded in year 1 and year 2, and lease liability and amortization, right of use asset balance would be 0 by end of year 2, with a charge of amortization expense and interest to the income statement, which would actually, the income got from that asset would actually hopefully make up for these expenses. Hopefully the revenues from the leased asset is more than the interest and amortization expense. So that is how a finance lease is recorded and accounted if one of that ONSA is satisfied. In the next session, I will demonstrate similarly the operating lease. Hello, friends. In the previous session, you saw a demo of the finance lease, and now you would see a demo of the operating lease, how it's accounted and recorded. Right? So let me show you the Excel. So I have put it here side by side so you can make a comparison. Right? Now, if none of those conditions are satisfied, if none of ONSA is satisfied, you would be recording the same asset as an operating lease. That is, if there is no ownership transfer, there is no written bargain purchase option, right? And N, let us assume that the fair value of the asset is maybe much more than the present value of the lease rentals here. And let us assume that it is not a 2-year life of an asset. Let us assume an asset life of 5 years. right? So 5 years, if you're taking it 2 out of 5 years, if you're taking 2 out of 5 years, you're taking only for 40% of the asset's life for the lease period, right? The lease period is 40% of the asset's useful life, which doesn't satisfy that 75% condition. So basically, if none of those ONSA is satisfied, you would account for it as an operating lease. How do you account it? Also, you would put it on the balance sheet. Previously, it was not put on the balance sheet, and now you would put. The implicit rate would be calculated just like this. Okay, I'll just repeat it, how it is calculated. It should come from the lessor, because the lessee cannot know it. Suppose the lessor has purchased the asset for 100,000. He would get 57,619 as rental for the first and second year. The implicit rate, it will be the rate of return, which is the internal rate of return for the lease, which is, as I showed you earlier, 10%. So all this is same until now, just like the finance lease. And then you would take the present value of all lease payments, present value of all lease payments at the implicit rate. If implicit rate is not known, the lessee's incremental borrowing rate can be used to discount the cash flows. So here we are going to discount this one at the implicit rate. To the power of 1 for the first year, second year, right? So it's the same so far as the operating lease. Finance lease. Total to be capitalized would be 100,000, right? So again, it's the same. 100,000 right of use asset is recorded, and the lease liability of 100,000 is recorded. Okay, right? Now comes the difference. Okay, first of all, the lease amortization table will be slightly different from the lease amortization of a finance lease. Here is there, lease payment is there, interest is there. Now, instead of payment of lease liability, it's amortization of ROU asset. You would be amortizing the ROU asset not in a straight line basis, but with this amount. Okay, and then the balance of the ROU asset, right? Everything else is the same. So the balance of the ROU asset is 100,000. Okay. And then the lease payments is 57,619. The interest portion is just like this. Exactly. Everything is the same. Okay. Everything is the same. So I might as well copy those. It's the same. Right? It's all the same. Right? It becomes 0 in the end. The ROU asset would become 0 because it will be amortized at 47,000 in the first year, and 52 in the second year. So the sum would be 100,000. It is fully amortized. Now, how would be the entries? Okay, the entry would be slightly different from a finance lease. You would record the lease expense, which is the lease payment, in fact, and that would hit the income statement. So income statement would have the full lease payment as lease expense. ROU asset would be credited when ROU asset is credited. It means that it's reduced. 47,619 as per the amortization table, this amount. And the interest amount would go to credit the lease liability. I will show you. You might be puzzled at this stage. Okay. So basically the lease liability account, I have put a T there. It would get a credit from the initial recording of ROU asset. From ROU asset, it would get a credit. Okay, I'll move my image a little up. Okay, and then with this first year entry, it would get a credit here for the interest expense. Okay, so it's getting an extra credit by lease expense. I'll put a short form. It's getting a credit of 10,000, right? Fine. And then there is another entry. We are going to debit lease liability because we have to pay the lease rentals, is it not? So we debit the lease liability by 57,619. We have to pay it. So far we are not paid. See? And credit cash 57,619. So the year one entry by cash it would get a debit 57. That's where we are debiting the lease liability debit. And cash credit. That's the first year entry. Now, second year entry. Okay, if you see, there's a big difference between in finance lease, we have recorded lease liability debit, interest charge debit, cash credit. Okay. and amortization expense was debited and ROU credited. Here is different. We are showing the entire lease amount, lease payment would be as lease expense. Whereas in the finance lease, the P&L was hit by interest and amortization, which comes to 60,000 and not 57,619. Okay. In an operating lease, the lease rentals will be on a straight line basis. It's going to be 57. 619, that's the lease expense. What is the ROU asset? ROU asset will get a credit of 52 as per the amortization table, 52,381. Okay, 52. We're not amortizing on the straight line basis. 52,381. And the lease liability would be credited with the interest charge, which is 5,238. 5,238. And then we would debit lease liability because we have to pay the entire amount. 57,619. And credit cash 57,619. So this is balance sheet. Lease liability and cash. Now let us see what happens to the lease liability account. So it gets one more on the second year. It's going to get one more credit of lease expense, but this time not of 10,000. You saw here it's getting a credit of 5,238, right? So 5,238. Just a minute. Not able to move this anywhere. Yeah. So 5,238 would get a credit. Right. And then second year cash, you're again paying. Lease liability debit, cash credit. So 57,619. Does the lease liability account tally? Does it become zero? It becomes zero. You can see it here. Take a sum of it. This sum. This is the amount. Then I'll copy that here. Also 115,238. So the lease liability account would have equal debits and credits. Its balance would be zero. Okay. So this is how the entire leases are accounted, both finance lease and operating lease. I've shown it to you with a very simple example of only 2 years so that not to complicate complicate matters, right? I've shown you how to capitalize the asset and record the lease liability. I've shown you lease amortization tables in both operating and finance lease. I've shown you the difference in entries. Just go through this and you are thorough with leases. You don't even have to read the text. Okay. But if you want extra information, read the text. It would make more sense after this. Okay. In the next session, we would do multiple choice questions to test your concept. Hello, friends. Let us do some multiple choice questions on leases. First, we'll do the number questions, and then in the next video, we'll do the word questions. Okay. So now, let me take you to the question bank, to those questions. Right. So these are the number questions. So to answer question number 5 and 6, you need to know how to make the lease amortization table, which I showed you in my Excel example in the previous video. Okay, so here it is a finance lease. So there's going to be interest expense as well as reduction of the lease liability. They are going to make a 25,000 lease payment. That's given. First payment due at the end of the year. Assume interest. That is the rate implicit in the lease is 8%, and lease liability is 99,818. So how much the first payment would be? Interest and reduction of lease liability. It's a typical question where you need to know the lease amortization table. Let us say year, and we don't have to draw the entire table. You don't have to make the entire table. Year, payment, rent payment, and interest part, principal part, which is the amortization of lease liability, okay, or reduction of lease liability. Let me call it the same words. Reduction of lease liability. That's the better word. Reduction lease liability. I hope it's clear. And the balance of the lease liability. So in year 0, there's no payment, no interest, no reduction of lease liability, but the balance would be 99,818. The first year payment would be 25,000. Out of this, 8% of the lease liability balance, 99,818, into 8% assumed rate of interest, 7,985 would be allocated towards interest. Now, B is the only answer with 7,985 as interest expense. The payment minus the interest expense, that is 25,000 minus 7,985, would be towards the principal, which is 17015 approximately 015, right? 17015 would be that, is exactly this. And the balance in the lease liability account would be 99,818 minus 17,015. Sometimes they can ask you the balance as well. So that would be 82,803. They would ask you what's the lease liability balance at the end of year one, something like that. Okay, so this is how you answer this question. Right, now for the second one, B is the right answer for that. For sixth one, also you have to make, he has asked you here, like I anticipated, in the balance sheet, the lease liability account should have a balance of what? Okay, so in other words, what will be the balance? We have to look at this column for the table we are going to make now. So here, payment, interest, reduction of lease liability, reduction of lease liability, balance of lease liability, which would be in the balance sheet at the end of year, at the end of the year. So in year 0, there's no payment, nothing. He has told you that this is the present value. Okay, so that would be on January 1st. So that is nothing but the lease liability. The asset also would have that value. Okay. And in year 1, he's asking you at the end of year 1, what would be the balance sheet lease liability. Okay. So what's the payment? The payment is 10,000 given there in the question. $10,000. The rate is here again 8%. So 8% of this. So 112,578 into 8% would be 9,006 for interest. 10,000 minus 9,006, it's a big lease, so that's why the major part of the payment is going towards interest because it's a 30-year lease, and only 9,956 4 approximately would go towards reducing the lease liability. The balance would be 994, 112, 578 minus 994 would give us 111, 584. So this is the balance what they want. Okay, so A is the right answer. If you want to make an entry for the first year, the payment is 10,000. So you'll credit cash 10,000. It's a finance lease, so the entry is going to be reduction of liability, that is debit, lease liability. A small amount because it's a huge, if the longer the term of the lease, the more would be the allocation of payment towards interest in the beginning years. And debit interest expense, a huge amount of 9,006. And to sum it up, it would sum to 10,000. So this is how the entry would be. I would suggest that you make an entry for this, for the first payment here by yourself. Okay, it's similar to this. So this is how we would solve a word question. So you should be very thorough about the amortization table and the columns it has. I've shown it to you on Excel for both operating lease and finance lease. Please go through that and you will be confident with any question that comes on leases. The next session, we would see those conditions which you have to remember. If you remember, I had discussed ONSA, right? So you would test your knowledge with that, with multiple choice questions in the next session. Hello, friends. Let us go to one more session on leases with word MCQs. So let's go to the question bank and try to solve them. So these are those conditions which would categorize, or criteria which which one of them should be satisfied in order to be classified as a finance lease by the lessee. Okay. So basically, these are the conditions. The lease grants the lessee an option to purchase the underlying asset, which the lessee would not be able to refuse. So this is actually the W condition of ONSA. The ONSA I have explained in previous videos. The lease term is a major part of the economic life of an asset. That is the S 75% or more of the estimated useful life or economic life of the underlying asset, the lease term should be 75% or more. The present value, this is the N part. Of ONSA, right? So the N part is the present value of lease payments and any residual value guaranteed. Should be substantially all of the fair value. That is 90% or more of the fair value of the asset. Okay. US GAAP has specified what is major part and what is substantially all, right? So one of these conditions should be satisfied. So any lease which has at least one yes, okay, any lease which has at least 1 yes is satisfying this condition. So he's asking which is the following would be classified as finance lease. So it would be A, which has 1 yes, C, which has 2 S's, and D, which has got 1 S. So C is the right answer. B would be an operating lease, right? Provided it is for a period of 12 months or more. If it's less than 12 months, 12 months or less, it would be categorized as a short-term lease. So let's go to the next question now. Which of the following is not true of a long-term operating lease? Not the short-term, long-term, not true. The lessee recognizes the right of use asset. The lease represents off-balance sheet financing for the lessee, not anymore. If it is short-term operating lease, it would be an off-balance sheet item. But here, they are going to recognize right of use asset and the lease liability. So it would not be off-balance sheet. Since we have to select what is not true, we are selecting B. Lessee records amortization of right of use asset. You can see my demo on Excel in the previous video. I've shown you this amortization. Yes, that is true. So the remaining are true. So we better concentrate on the wrong answers, which is true actually. The lease arrangement represents a form of financing for the lessee, which is true. All leases are financing from the lessee. When the lessee or the company doesn't have to pay anything in cash and they're getting something, then it is financed. Okay, right. So B is the right answer for this. Let's go to the next question. Again, which is not a criteria for classifying it as a finance lease, which is not a criteria. the underlying asset is expected to have alternate use to the lessor is not a criteria. It's not expected to have alternate use is a criteria. Okay. So basically the asset is like custom made to the lessee. It doesn't have any other alternate use. But here he says it has an alternative use, which is wrong. It's not a criteria for a financial lease. So this is the end part, the present values of the sum of the lease payments and any residual value which the lessee has to pay in the end of the lease term equals or is greater than substantially all of the fair value has been classified as 90% or more, so that N of ONSA. So this is a condition. So that is not the answer. Ownership transfers to the lessee at the end of the lease period is the O condition of ONSA. It's one of the conditions. So that's not the answer. The lease grants an option to purchase, which the lessee will not refuse. So that is a return bargain purchase option. Anything bargain purchase, you're purchasing below the fair value. Okay. So this is also a condition. So that is not the answer. The answer is A. Which is not a condition. Okay. So let us go to the next question. So if there's a 3-month period, it's a short-term operating lease. Okay, machine is delivered in August 1st. Okay, August 1st, and the rental are due on the first day of each rental month, right? Assuming it has made an accounting policy of election not to recognize these assets or liabilities for short-term lease. This is a short-term lease because it's a 3-month agreement. The effect this event would have on company's 31st July financial statements, okay, is there's no change at all. There's no change in assets. Had it been a long term, the time they enter into the agreement, they would have been a right of use asset and a liability, lease liability. But since a short term and they're choosing not to recognize for short term leases, A is the right answer. No change in assets, liability, or income. So that's about leases and the kind of questions you can get. Mainly you saw they're testing you on those ONSA conditions for financial lease. And you should know the amortization table, which I showed you in my Excel demo. So we are done here. You should be able to answer any question which comes on leases for the CM exam. Hello, everyone. Welcome to the lesson on equities. So today I will be taking you towards to the text, explaining the concepts, and then doing the multiple choice questions. So what is equity basically? Equity is the balancing element of the balance sheet. What do they mean by that? It's like this. I will show you a small balance sheet here. Excuse me. Just a small balance sheet. In a T form, where the liabilities and equity will be on the left side and assets on the right side. So if they have assets of, let us say, 100, it means that the liabilities and equity should also be 100. Right? So suppose we have liabilities of 75, the equity should be 25. So that is the balancing figure, right? So it also represents the residual ownership of assets. What do they mean by that? After paying off all the liabilities, suppose you have the assets of 100, after paying off all the liabilities, what you'll be left with? That is equity. So that's one more way of looking at it. Okay. So regardless of the business form, the definition of equity would be assets minus liabilities. Okay. So then, but you should note one thing: assets are recorded at historical value. Okay. And it would be liquidated at market value. So at the time of liquidation, it's not necessarily the shareholders will get 25. Okay, because it depends on the value of the assets at that time. Okay, so when the assets are liquidated at the market value, these two amounts would never be the same. That is 25 and what they would actually get, the liquidated values, it would never be the same. Okay. So what are the components of equity would depend on the ownership of the business, right? Or the business form. What kind of form of business it is, it would depend on that, because owner's equity section for a sole proprietor would be only one capital account. For a partnership, it would include capital accounts for the partner. Okay, so the form of the company, the legal form of it would the equity components would greatly depend on the legal forms of the business, right? So for a company, for a corporation, the equity would consist of capital stock, additional paid-in capital, retained earnings, and also accumulated other comprehensive income and non-controlling interest. Treasury stock also would be included. This would be for a company. For a sole proprietorship, it would be only capital account. For a partnership, the capital account of each partners. And sometimes on the exam, it would be called owner's equity, stockholders' equity, shareholders' equity, or just equity without anything attached to it. Okay. Also, you should note that when they say net worth, what's the net worth of the company? It means equity. And sometimes they would also say net assets, change in net assets, change in net assets, or just net assets would also be equity. If they say change in net assets, it's change in equity. So these are the terms you should be very familiar with and not get confused when it is addressed by a different name. Okay, now let us go into more detail for a company's, a corporate shareholders' equity, right? It would include of contributed capital, retained earnings. Now, contributed capital would be the common stock and additional paid-in capital. So whatever the owners have put in, okay, the fair value of what is received by the company in exchange for shares is recorded in two different accounts. The capital stock account, where only the par value, the minimum value of the shares, or the legal capital even has been sold, that would enter into a common stock account. And anything above that would go into additional paid-in capital. Retained earnings would represent the undistributed profits less any dividends. Okay, so these are the profits which are plowed back into the company. I have already discussed about accumulated other comprehensive income in my previous videos. So owner's equity could also include other comprehensive income, treasury stock, which the company buys back from the stock market, right? It's a contra equity. Treasury stock is a contra equity. What do you mean by contra equity? Contra equity is actually shown on the equity side, but with a minus sign. Suppose if you have a common stock of 100, a treasury stock would go to reduce it. It will not be shown as an investment, even though the company buys its own shares. So it is the shares that have been repurchased by the issuing company. So if the treasury stock is, let us say, 5, it would be shown with a negative sign there, and 95 would be the net equity. So that's what it means by contra account, contra equity. Right. So what is other comprehensive income? I have told you accumulated other comprehensive income are those items which are not included in the income statement. There are 4 of them. I have dealt with it in the previous class. Okay, but income statement items would go into retained earnings, whereas the 4 items which are not going to be flowing through the income statement would go into the accumulated other comprehensive income, right? The treasury stock account, as I told you before, is a contra equity account that carries a debit balance, but it reduces equity on the balance sheet. Non-controlling interest is when a company owns more than 50% of another company. The part it does not own would be the non-controlling interest. So, for example, suppose this is a company's balance sheet. Okay, this is a company's balance sheet. And let us say this is the acquiring company. Acquirer. I will put acquirer. And this is the target company. Okay, so the company with its cash, let us say it has an equity of 100. Okay, and cash of 100, and with its cash, it acquires A, B, C, D. So the shares of this company, let us say, I'm just putting it in a very simple form. Okay, this target company also has got cash of 100. Okay, So with this cash, if the company acquirer acquires 75% of the shareholding, this 25 which is not acquired is called the non-controlling interest. And in a consolidated balance sheet, it would be shown in the equity section as non-controlling interest. I hope that is clear. Right? So that is how it would be shown. So when they consolidate, just let me consolidate it for you here. Consolidated, it would show, like they have told you, 100% of the assets are recorded. So actually this cash will not be, this cash will have 75 is been purchased. So cash balance is going to be only 25. Okay, the investment would be there. The investment would be actually 75, and that would be set off. Okay, the investment of 75 would get set off with this equity, so you will not record the investment. You will record the company's acquirer's cash balance of 25 plus the target's cash balance, so 125. The investment account would be eliminated. I've shown that in the investment videos. The equity would remain the same. And now you have D, which was not acquired, right? So that would be 25, and this is the minority interest or non-controlling interest. Non-controlling interest. And the balance sheet agrees. So this is how it would be consolidated, and this is the meaning of non-controlling interest, right? So that part is clear. Let us see what else they have. Here. So let's go to the next page. Here it talks about common stock. Common stock. Now, what is it exactly? The par value, the par or the stated value would go into the common stock account. It is the legal capital of the company. So under no condition, under no circumstances, they should be distributing, the company should distribute this money, which is lying in the common stock as dividend. They will not distribute it as dividend. Okay, so that's what it specifies here, that it cannot be distributed as dividend. Okay, so that's why companies do have its legal capital as a very low par value. Okay, so it's the minimum value. So if the shareholders have not paid the full amount of par value, they would have to pay it up in case of liquidation. So the shareholders' liability is limited to the par value of the stock. Right? So the statement here is the maximum amount of shareholders' personal liability to the creditors of the company. So as long as the par value has been paid to the corporation, the shareholders can obtain the benefits of limited liability. That is, in case of liquidation, the potential for loss is limited to the par value of the shares. Okay, so sometimes they are paid at a discount. Sometimes the stock is issued at a discount that is less than par value. In such a case, in case of liquidation, the shareholders can be called upon to pay that extra amount. And some states do not even allow the shares to be sold at a discount. This is the minimum value of the shares when it was registered. Okay. Some people have no par value. Some states have no par value. Then the legal capital is the total amount received when the shares were issued. And that whole thing would be credited into common stock. There's no bifurcation between par value and additional paid-in capital. Anything paid at the time of issuance of stock, anything paid more than the par value would flow into another account called additional paid-in capital. So the issuance of common stock would have this entry. I'll give it to you with an example of figures. Let us say they received $100 cash. And the par value is as low as $10 per share. So that would go to the common share as a common stock account. And the balancing amount would go to the additional paid-in capital. The entry is the same even for preference shares. Only thing, it would be called additional paid-in capital preferred stock. And instead of common shares here, or common stock sometimes, it would say preferred shares. That's all. Right. So that is about it. Right. So let us talk about dividends in the next session so that not to make this session too long. We will attack some multiple choice questions in the meanwhile. Hello, everyone. So let's do a multiple choice question on what we have studied so far on equity. We go to the question bank. So Hessler is a company, received cash in the amount of 180,000 on March 11 for 10,000 shares of common stock sold. So the company has issued common stock. The common stock par value is 5 per share, the legal capital, as I explained in the previous video. The amount recorded as a credit to common stock account for this transaction would be only the par value. That is $5 into 10,000 shares, which is 50,000. That is the answer, because common stock would have only the par value. While we're at it, let us do the full transaction. So actually it would have a debit to cash account of 180,000. Credit to common stock, which was the question actually, only the par value, which is 50,000. And the plug-in would be additional paid in capital common stock. Okay, I'll put there CS standing for common stock. That would be 130,000. So this would be the full transaction. Sometimes they can ask you how much would be credited to the additional paid in capital as well. So this would be the full entry. So yes, from what we have already discussed and from what I have already explained, this is the only question we can do right now. Let us go back to the text, learn more about equity, and then attempt the remaining multiple choice questions. That would be in the coming sessions. Hello, friends. Welcome to another session on equity. I've explained the basics of equity. Now we'll talk about dividend. What are actually dividends? Let us go to the text. And I'll explain from there. Dividends if you look at the dictionary meaning, it's something that is distributed. Okay, so the profits are basically distributed. The profits of the company are distributed to the owners of the company. Okay, so the declaration of cash dividends, we'll talk about property dividends later on, reduces the total shareholders' equity, okay, because assets are going out and equity is also reduced. So at the time of declaration for cash dividends, okay, the time of declaration, when it's decided by the board of directors, they would actually pass this entry: debit retained earnings, thereby reducing the profit, and credit dividends payable. A liability is created immediately the moment on the date of declaration, when the board of directors formally declare dividend. Right? So this, as mentioned here, would reduce the working capital. Why is it reducing working capital? Because since it reduces working capital, because a liability is formed. Okay, so they have put this entry here itself, the one which I just now explained. So a liability is formed. So liability is formed when the company declares dividends. Okay, and then you should be familiar with these dates. The date of record, this is when the company would actually decide who will receive the dividend. Anyone who owns the shares on the record date would be receiving the dividend when it is paid. A journal entry is passed on this date to adjust this entry, because this entry of debiting retained earnings and crediting dividends payable would be an estimate, more or less an estimate, okay, because it's told here, it's estimate of how much dividends the company will pay based on the ownership at that particular point. Then later, many people would exchange ownerships. Okay, many people, they'll be buying and selling shares. Okay, and then at the date of record, they may have to make an estimate, make an additional entry for debiting retained earnings and crediting dividends payable, or reduce it or whatever, based on the amount of, based on the people or the owners who will receive the dividend the time of date of record. So date of payment is when they would debit dividends payable and credit cash. If you remember, we had credited dividends payable here. Now it's debiting and crediting cash. So assets are going out of the company. So whenever assets are going out, a liability is created. So declaration of cash dividend would have given rise to a liability. There is one very important date called the ex-dividend date. People who own shares after the ex-dividend date will not get dividend. So you should be very, very concerned about this date, because if you want dividend, okay, you should be purchasing the share before the ex-dividend date. And here, Hawk has given a very important point here. Currently, the established standard in the US for ex-dividend date is one day prior to the date of record. So you have to purchase it. Now, for example, if here, we'll take this example. If the date of record is Thursday, January 11th, the ex-dividend date is one day prior to that. So if you want dividend, you should purchase the share on January 9th. Otherwise, if you purchase it on January 10th, let us say, you would have the share, but the previous owner would get the dividend. Okay, so therefore, the ex-dividend date and not the record date determines which shareholders will receive the dividend. Okay, but anyway, it's based on the record date because it's 1 year prior to the record date. This is a very important concept that you should know as an investor as well as for the exam. Right? So that is about dividends, cash dividends. We will be tested on this. It's a very common testing ground for the IMA to test on cash dividends and also stock dividends. We'll come to stock dividends later. In the meanwhile, we'll see if we can do a multiple choice question on this topic. That will be in the next session. Hello, everyone. Welcome to another session on equities. And now we will do some multiple choice questions based on dividends. So let me share the screen. I've selected a multiple choice question here. Have a good look at it and try to do it by yourself. So this is the financial position or an extract of the financial position or balance sheet of Lando Corporation as of 30th September, the current year. They have current assets, current liabilities. The board of directors met on October 4th, the current year, and declared a regular cash dividend of 750,000, that is 0.60 per share. The dividend is payable on 25th of October to shareholders on record as of 12th of October. So all the dates are given here. This is the record date, right? And this is the payment date, and this is the declaration date. Okay, now I'm going to ask you, how many common shares are there? Is 750,000 is the total amount of cash dividend, and 0.60 as the dividend per share. So can you just calculate and tell me how many are there? How many shares are there? The number of common shares. So you should take some time and do it. Do not multiply it. You have to divide. Because it's like this. 0.6 per share has been given. So we don't know the number of shares. So that multiplied into number of shares would give us a total dividend of 750,000. This is not what they have asked. In the question, but I'm just giving you some practice here. So what are shares? How many shares are there? So shares is going to be dividing 0.6 on both the sides. It should be 750,000 divided by 0.60. So how much will that be? 750,000 divided by 0.60 would give us 1,250,000 shares. This could be a question, so I'm preparing you for it. Right? You can verify it. Now, 1,250,000 shares, each one given $0.6 as dividend, should give us the total dividend amount. Anyway, this is not what they've asked. This is just something for you to calculate. Right. So assume that this was the only transactions by Lando Corporation during October. The dividend transactions and the closing entries have already been made, right? What was the effect on the company's total equity? So for that, let us analyze the entry. Okay, so at the time of declaration, it would have been debit, debit, retained earnings. So that would affect equity, 750,000. I'm truncating the zeros. And credit, a liabilities form. So working capital also would reduce. Equity will reduce. And working capital also would reduce because it would increase the liability. Okay. So now, among the choices, we should see that the total equity was decreased. The unchanged part we would strike off. So that part we should strike off, eliminate it. And then what happens during payment? Because he's asking on dividend payment also. Dividend payment would actually debit dividends payable. $750 and credit cash 750. Working capital would not be affected because liability as well as asset is being reduced. However, they're asking about equity, not about working capital. What happens? Equity, there's no change in equity because equity accounts are not touched here. A liability account is touched and a cash account is touched. Okay, so there is no effect on equity account. So it says increased by dividend payment, which is wrong. So D is the right answer. Decreased equity, total equity reduced at the time of declaration and is unchanged by the dividend payment because equity account is not touched, a liability account is debited, and a asset account is credited. D is the right answer. Let us go to more topics on equity before we attempt the other multiple choice questions in the next session. Hello, everyone. Welcome to another session on equity. And now we will be doing more questions on cash dividend concept. So let me go to the question bank. This question is a very easy one. So it's a level A question, should be able to answer it within 10 seconds, because this should make up for the average time you would be taking in the exam. So cash dividends are declared. When cash dividends are declared, which accounts are affected? Dividends receivable? No, that would be for an investor. Retained earnings is the right one, because when it's declared, the entry is going to be debit retained earnings and credit dividends payable. A liability is created. So B is the right answer. Additional paid-in capital is not going to be affected for a cash dividend. It can get affected for a stock dividend, which will come to later. And common shares are not affected. However, common shares could be affected in a stock dividend. Okay, so that is it. Now let's go to the next question, which can be a little challenging. Right. I would suggest that it involves here preferred dividends as well. Okay, which the concept I have explained, the concept of preferred dividend, or I would be explaining it further in when I'm talking about equities, right, in the coming sessions. But we can solve this question even without that discussion. So the first thing they're asking you here is the total amount of dividends. That would include the common as well as preferred dividends. They have, you see, they have a 5% cumulative preferred dividend. Preferred stock, which means the dividends accumulate if you don't declare. Okay, if you don't declare in a particular year, it would have to be made up. Okay, so it would accumulate and eventually you have to pay the arrears. The board of directors last declared dividends for the year ended 31st May. Their year end is 31st May, year 2000. So if they have declared dividends, right, it could be for common stock as well as preferred preferred stock because they cannot pay common stock dividend without clearing the arrears of the preferred stock dividend. So there were no arrears there were no dividends in arrears at that time. Now it is May 31st, 2002. The company had an income of 1.75 million. The board of directors declared dividend for common shareholders equivalent to 20% of net income. Generally, it is actually declared per share, but here they have told 20% of net income. What's the total amount? So they have last they paid was 31st May. Year 2000, I'll say, okay. So that was paid. So now they have to pay for the year they have to pay preference dividend for the year 31st May 2001. So here 1 year is pending. And also they have to pay for 31st May 2002, which they have told us to find out the total dividend. So 2 years of preference dividend is pending. We have to clear the preference dividend, especially if it's a cumulative preference dividend, before we pay the common stockholders. Okay, so now how much is it? Preferred dividend or preferred stock dividends calculated always on par value. That's not the case with common stock. Common stock is paid sometimes per share. Right? So 5% of this 100 would be $5 into 6,000 shares. So each year it would be $30,000. So they have to pay 30,000 here for 2 years. So preferred dividends would be 60,000. That they have to clear before they pay 20% on the common shareholders. Now, some students would actually deduct this preference dividends from this income. That's not correct. That's not correct because preference dividend and common stock dividend is not paid out of net income. It is paid out of retained earnings. Okay, so even if you have a zero net income for the year or even a loss, but you have balance in retained earnings, you can pay dividends. Okay, so 20% of this would be 350,000, 20% of the net income. That's how they plan to pay the common shareholders. So totally 410,000 is what they would pay as total amount of dividends for both preference shares and common shares. D is the right answer. If you have any questions on this, any clarifications required, you can always contact me on office hours, and also I'll give you my number as well. You can WhatsApp me, right? You can send it through WhatsApp. I'm sorry, here. This is my number, 988-0054-962. You can send me your question on WhatsApp. This is the country code, +91. Is a country code. So you can give me a question on WhatsApp. If possible, I'll answer on WhatsApp. Otherwise, you'll have to wait for office hours for a very detailed explanation with writing on the whiteboard as well. So the next session would be about liquidating dividend. And that will be one more topic under equity. Hello friends, welcome to the lesson on dividends. And let us go to the text. And we have already discussed cash dividends. And now we will be discussing the other dividends. So the next dividend, what we would be learning about is liquidating dividend. By the way, before I forget, I should mention that these dates declaration date, ex-dividend date, payment date, date of record, all these are very important concepts. They were tested in the last window and they would be tested again. So please be very sure about the concept of what those dates. I've explained it in detail, but you can also read the text to have another view viewpoint of it. And now we'll go on to liquidating dividends. So liquidating dividends is a return very rightly said here, it's return of capital, not on capital. So it's not a return on capital. Okay, so anything which would exceed, any dividend which would exceed the balance in the retained earnings is classified as liquidating dividend, because it's not a distribution of profit, it's a distribution of capital itself. So the first account, because the common stock account will not be touched until everybody is paid off. Okay, so what could be touched is the additional paid-in capital account. So the entry would be this way: debit additional paid-in capital with the amount of dividend and credit dividends payable. Okay, this happens in mining companies, etc. Once the mining is done and everything is over, they would be returning back the capital to the shareholders. So it's very common in mining industries. And the state in which the company is incorporated should allow liquidating dividend. It should be as per the law of the land. In certain countries, they don't allow to pay out of capital. So here a dividend can be partially liquidated as well. So if you see here, the part which is debited to retained earnings is a regular dividend. It is not a liquidating dividend, but the part which is debited to additional paid-in capital is liquidating dividend. And you credit dividends payable, and later on you would debit dividends payable and credit cash. Here they are directly credited cash. Okay, so that's all. That's the concept about liquidating dividend that you should be knowing. So let's go on to property dividend. What is property dividend? When the company doesn't pay cash, it would pay property, something some asset that the company might have. Usually it is shares which the company owns of other companies, which it would give out as dividends. For example, HP company might hold Microsoft shares. Okay, so if HP company holds Microsoft shares, Microsoft shares as an investment, HP company can give out the share as dividends to common shareholders. And that would be property dividend because it's not cash. They would literally give these shares. They wouldn't sell the shares and give the proceeds. They would give the shares itself. But sometimes, however, if it is about fixed assets or inventory, they cannot give the fixed assets itself to the shareholders. So they might first sell it, and out of the proceeds, they would give dividend. Okay, so generally, when a company declares property dividend, it does not mean the company does not have cash. Okay, but it might be needing the cash to finance other investment opportunities. So it might give out property dividend. It is on record that the Wrigley Chewing Gum Company once gave out chewing gums as property dividend. Now that's very funny. I wouldn't imagine any shareholder wanting chewing gums, but that's what happened, right? So you can even Google it up and read more details about that. So now, what are the entries for this? First of all, at the time of declaration, the retained earnings would be debited by the amount of the fair value of the asset it's distributing. And later on, it distributes that asset without worrying about the fair value thereafter. So at the time of distributing the property dividend, fair values are not recorded. Fair value probably would be recorded in the investor's books who is receiving the dividend. So here, if you look at this example, it explains it all. On July 1st, Lemon company declared dividend consisting of common stock it owned in another corporation, Devery Corporation. The carrying value as of July 1st is $1 million and the market value is $1.25 million. At the time of property dividend declaration, bumps the investment up to the market. Debit investments, $250,000, and credit gain 250,000. So that way it would bump this up to 1,250,000. And then it would debit retained earnings by 1,250,000 and credit property dividend payable, a liability, 1,250,000. And at the time of paying, it would debit property dividend payable and credit the Dairy Corporation's shares. It's going out. So when an asset is going out, it's credited. So it's removed from the books. This is the way a property dividend is recorded. So now a question might ask you, what is the net amount which was debited to equity based on this property dividend? The net amount would be not 1,250,000, but the book value. Because please observe, you are debiting retained earnings by the market value as of date of declaration. But you're also recording a gain, which is in fact going to be closed as a credit to the retained earnings. Okay, so if this debit minus this credit, the net book value or the carrying value of the investment is what will be debited to the retained earnings. So that's what they mentioned in the note there, what I just now explained. Right, so that's what he has explained there. Okay, what about the property dividend for the shareholder or the investor? When the investor receives the assets distributed as property dividend, right? So what he does, he would record the journal entry debit assets received and credit dividend income at the fair value when he receives it. When the shareholder receives the asset distributed in the property dividend, not when it's declared. The shareholder recognized dividend income at fair value of the assets received. right? So the journal entry would be this way. So that's all you need to be knowing about property dividend. And liquidating dividend. If there are any questions related to this, I'll be doing it. In the next session, we will talk in more detail and in great detail about stock dividends and stock splits. Hello, everyone. Welcome to another session on equity. And now we will be talking about stock splits and stock dividends. So first we'll talk about stock splits, stock dividends. So let's go to the text. So when does a stock dividend happen? A stock dividend happens when a company distributes dividends in form of shares instead of cash, right? And sometimes there's a transfer from retained earnings, because it's basically a distribution of profits, to common stock and APIC accounts. Additional paid-in capital accounts, right? So even though no cash is given out, this is the amount owed to shareholders, right? So sometimes common stock and APIC accounts are affected, and other times, if it's a large dividend, only the common stock account would be affected and retained earnings would be affected. Okay, so let us see when it can be called small or large. So the journal entry entirely depends on the size of the dividend. Okay, so let's go to the next page. Right. A small stock dividend is when it's usually 20 to 25% of the total shares outstanding. A little bit vague here. They're not correctly, it's less than 20 or 25% of total shares outstanding. So they're not correctly pinpointing, not being specific about what is it going to be, less than 20% or less than 25%. I'll explain that in a while. Okay, so now a stock dividend is a small stock dividend is usually less than 20 to 25% of the total shares outstanding. So for example, if you have a shares outstanding of 1 million shares outstanding the company has, right? And it's distributing only 100,000 shares, right? It's distributing only 100,000 shares as stock dividend, in which case it is only 10% of the total shares outstanding, and it would be categorized as a small dividend. So when it's less than 20 to 25% in that range, of the total shares outstanding, the entry, the journal entry will be different. Retained earnings is debited with the fair value of the shares. Okay, so whatever the market value at the time of declaration, retained earnings will be debited with that. And common shares would be credited with the par value, and the remaining amount, because generally the fair value would be higher. Let us say the fair value is $60, the par value is $10. Okay, the par value is $10, and the additional paring capital would be $50. Okay, no adjustment is made for any change in the fair value when it's distributed. That's between the declaration date and the date of issuance. So now, why are they debiting fair value instead of just the par value? Because a 20 to 25% dividend would actually not have an impact. It's a small dividend, right? Less than 20 to 25%. So it would not have such an impact on the market value of the shares, right? Because it's small. The supply of shares in the market would not increase drastically. So the fair value, it would reduce a little bit, but it would be more or less the fair value existing at the time of declaration. Right? So, and the shareholders, the investors are receiving shares which have the same market value. So that is why actually the retained earnings are the investors' dividends. right? Because dividends are distributed from retained earnings. So since they are getting the benefit of fair value of the shares given to them, the retained earnings will be debited with the fair value of shares. And why this 20 to 25%? Depends on the market and depends on the shares, right? So for some shares, less than 20% would not affect its fair value. For some shares, less than 25% also would not affect its market value. Okay, so that is why it is debited with the fair value. However, if it exceeds this percentage, if it exceeds this percentage, it becomes a large stock dividend. And in a large stock dividend, the number of shares in the market would be more. The supply goes more, the market value or fair value will come down. So that is why what the authority is, the standard makers have decided that in such cases, when it is more than 20 to 25% of the total shares outstanding, in some markets, more than 20% itself would affect the market price of the share. Yes, and it would go down. And in some markets, more than 25% of the outstanding shares would affect the market, right? Market value of the shares. So since it's affecting the market value of the shares, the share price is going to go down. Retained earnings is only debited for the par value of the shares. And APIC in this case will not be credited, only common shares would be credited. First, it will go into a temporary account as common shares issuable as dividend, which is in the equity section itself. And later on, when the stock is issued, common shares issuable would be debited. And common share account is credited with the par value of the shares issued. I hope it is clear. So what he says here in this note is that one very important point. Since it's a movement within the equity section, there's no liability created. Nothing no assets is going out of the company. Right? No assets are touched. The asset side of the balance sheet is not touched at all with a stock dividend. So no liability is created. When resources are not flowing out, no liability is recorded for a stock dividend. However, for a cash dividend, there is a liability because cash will be going out or property will be going out. Okay. So for those things, whenever asset side of the balance sheet is affected, a liability is created. In this case, there is no liability. Okay, so it will be moved to a common shares issuable as dividend account in the equity section itself, or any such similar name. And at the time of distribution, you would debit common shares issuable as dividend and credit common stock, right? So that is how it is going to be. And this is for a small dividend. Remember, it's going to be fair value, and for a large dividend is going to be par value. In the next class, we'll talk about stock splits. Hello, friends. Welcome to the class on equity. We'll speak about stock splits in this class. So, what are stock splits? Like the name suggests, shares are split. They're torn into pieces. Sometimes more than two pieces. Okay. So, for example, a 2-for-1 stock split, the owner of the share would have twice as much shares. But you see, a share is this way, right? It is just now two pieces. Okay. So in a sense, they're not just going to tear the share certificates, they are going to give two shares. What is the benefit for an investor? Nothing, in fact. Okay. Because you see, if he has a sandwich, just imagine he is having a sandwich. Okay. And he would split it or cut it into two. So now he has two pieces. Right? He has two pieces of the sandwich. It doesn't mean he has two sandwiches. He has one sandwich itself. Okay. So there is no actual benefit to the investor, but there's a benefit to the company. Okay, the investor's benefit would be that the market price would reduce and a retail investor, if the share was priced too highly, a retail investor might be able to buy it. Okay, so it increases the liquidity. Fine. Other than that, there is no other benefit as such for the shareholder, but the company, in order to avoid takeovers, etc., they might resort to a stock split then, because then there are more shares to acquire. Okay, so a 2-for-1 stock split means for every one share, two shares are distributed. Right? But in a stock split, par value also of each share gets reduced. No other dollar amounts in the balance sheets are affected. Okay, the par value, except the par value, no other dollar amount are affected. For example, if they have 1 million shares of $1 each, the total common stock account is 1 million. If a 2-for-1 stock split is made, there's now going to be 2 million shares. Okay, so 2 million shares at par value, proportionately, it's going to reduce. Right? It's going to become half. 1 divided by 2. Par value would become half. The number of shares would double. So 2 million into 0.5 is again $1 million. So remember one thing, guys. In a stock split, no dollar amounts are touched. The balance sheet, total amounts of the balance sheet would remain the same. So they would confuse you a lot by asking and twisting and turning this question in many ways. But just be very, very firm that the total dollar amounts will not be changing in case of a stock split. The only dollar amount would change is the par value, right? So they have twice as many shares for a 2-for-1 stock split, but the market price also would go down, right? It's not that the shareholders would get richer. The market value would go down proportionately, and the market acts very fast. So there's also a reverse stock split. So generally, a stock split, an ordinary stock split is done in order to have more shares and to bring down the market price. Okay, because it might have been priced too high and investors are not able to invest in those shares. So a stock split has no journal entry made. Having said that, a memo entry just to demonstrate that a stock split took place. So if you notice, it would be like, for the example which they are given, debit 1 million shares at $1. You're removing in that and crediting 2 million shares at $0.5. So in both cases, the debit would be $1 million. And the credit also would be $1 million. There is no change in dollar amounts, total dollar amounts at all. Sometimes they perform, companies do perform a reverse stock split. You will get that time 1 share for every 2 shares you have holding. For example, if you have 100 shares, you would end up getting, you may have to surrender these shares and you end up getting 50 shares. One for every two. So 100 divided by 2. So you will be getting 1 share for every 2. So you will get 50 shares. Why do companies do that? Because maybe what would have happened is the share price has gone down, right? And it might be in the danger of being delisted from the stock exchange. It has dropped so low. So the the reverse split would double the price of the share, market price of the share. Right? So basically, the total shareholders' wealth here again would not change. Okay, he will be holding half the amount of shares, but the market share would have doubled. Market price would have doubled, and his total wealth would be the same. Again, here for the stock split, the total dollar amounts in the balance sheet is not going to be changed. For example, if you reverse this, this, 2 million shares would become 1 million, but the par value would have doubled. Okay, so the total amounts would remain the same. So this is about stock split and stock dividends. Now you're ready for some multiple choice questions. We would do that in the next session. Hello friends, welcome to the lesson on equity. And now we are going to do multiple choice questions, which would cover stock dividends, stock splits, and even treasury stock. So let us go to the question bank. So here the board of directors of Marcum Corporation met on 5th of May 2005 and declared a 10% stock dividend. The dividend is a small dividend. 10% comes under small dividend category. The dividend was distributed on 28th of May to the shareholders of record as of 15th of May. Okay, so as a result of declaration and distribution, what would be the effect on Markham's liabilities? As I mentioned while I was explaining the concept of stock dividend, no liabilities is created because the value of the company does not reduce, no assets are going out. Okay, so anything which says unchanged needs to be seen. So just remove this disregard this decrease, nothing would decrease. Okay, and yeah, there are three unchanged. So one says unchanged by dividend declaration. That is correct. That part is correct. Because current liabilities would not be affected whatsoever, but increases by dividend distribution. This part is wrong, so the answer is wrong. And C, it says unchanged by dividend declaration. That part is correct, but decreases, no. There is no effect at all on current liabilities. So we have to see that answer. So here it says unchanged by either declaration or dividend distribution. So that part is correct. Right. So let's go to the next question. I will search for the question so that we go to the question directly. Yeah. When a company desires to increase the market value per share of its common stock, what should the company do? If it sells the treasury stock, what are treasury stock? The treasury stock, which is the company's own stock, which the company purchased from the open market, from the share market, from the stock exchange, right? So it purchases it and keeps it in treasury. So it is basically issued, but not outstanding because it's with the company. It will go to reduce the equity. So it's a contra equity. So if they sell that stock, it will not increase. There will be more stock in the market. So generally, when they buy treasury stock, the market price gets inflated a little bit because there's lesser supply. Implementing a reverse stock split is the right answer because it would actually reduce the number of shares outstanding. And a 1-for-2 a 1-for-2 reverse stock split means for every 2 shares, you will get only 1 share. So your shareholder if it is 100, it would become 50, but still the price would double in the market because the supply is down. Selling preferred stock, we won't have any effect on the market at all, on the common share market, right? And split the stock is actually, when they say split, it is the other way about, increasing the number of shares, like say 2 for 1. For every 1 share you hold, you get 2 shares. That would increase the number of shares in the market. And the price would go down. So what would increase the market price? Reverse stock split. So B is the correct answer. Let's go to the next question. So par value. I explained about par value. It's the minimum value of the share, right? And it represents the legal capital. It is not to be distributed as dividend until everybody is paid off. And if the shares have been, if the par value has been paid partly, in the event of bankruptcy, the shareholders would be called to pay the remaining amount. So basically, it's the liability ceiling of a shareholder when the company undergoes bankruptcy. So that means the shareholders can be given everything away as dividend, right? Even liquidity dividend, which would include additional paid-in capital, but they should keep the par value until everyone is paid. So that is the minimum amount which the shareholders can, that's the maximum amount the shareholders can lose in the event of bankruptcy. So B is the correct answer, right? So the estimated fair value of the stock would be much higher than the par value. Usually, sometimes it can go even lesser in some circumstances, but usually the fair value would be higher than the par value. It is the total value of the stock that must be entered? No. The entire proceeds from selling the common stock should be entered in the corporation records, which could be the par value plus additional paid-in capital. Now, paid-in capital would include par value plus additional paid-in capital as well. So B is the right answer. Let us go to the next question. Yeah. So basically, there's a concept here. On 1st of December, the directors declared a dividend of $1 for 50,000 shares of common stock outstanding. The company also has 5,000 treasury stock. So do we pay this treasury stock also the dividend? That is the concept here. Answer is no. The 5,000 which is held in treasury, that means the company's own stock, which the company has purchased, right? So that is issued but not outstanding. Dividends are paid to the shares outstanding. So this 50,000 is after deducting that the shares of treasury stock. So we don't have to do 50,000 minus 5,000 also, and we don't have to add 5,000 to this. We would pay dividend only to the shares outstanding. So that is $1 per share, and that would be a debit on the date of declaration, a debit to retained earnings of 50,000. So that's what it would be. Debit to retained earnings and credit to dividends payable, 50,000. So B is the right answer. The debit to retained earnings for 55,000 looks like they have included the 5,000 treasury stock. You don't have to pay dividend to the treasury stock. It's held by the company itself. So it's not outstanding and we don't pay dividend. So let's go to the next question. The next question is E1. Yeah. A stock dividend, these are all level A questions. A stock dividend increases the debt to equity ratio of a firm. Well, it doesn't change anything because a stock dividend does not change the equity, the total equity at all. So it remains the same. And that is also not touched. Decreases future earnings per share. Yes, it's possible that it decreases the future earning per share because more number of shares are there in the market or issued to the shareholder due to a stock dividend. So his earnings per share would go down. Decreases the size of the firm. There's no effect on the size of the firm because nothing goes out, nothing comes in. Increases shareholders' wealth is debatable. Usually, when stock dividend is issued, the stock price should go down even though the number of shares have gone up, right? I'm sorry, the number of shares, yes, the supply of the shares would have gone up. So the share price should come down proportionately and shareholders' wealth should not experience any increase or decrease. However, in reality, sometimes stock dividends have different effects on the market. If it's a small stock dividend, the market price is not affected so much, so shareholders end up getting more shares and their wealth would increase. It all depends on the demand and supply of the shares with the stock dividend. If it's a large stock dividend, market price would be affected. So even though they have an increase of shares, the market price reduces so their net wealth, the total wealth remains the same. So it's very debatable what a stock dividend would have on shareholders' wealth, but usually it doesn't affect. And yes, you can expect decrease in future earnings per share because of more number of shares held by the investor or more number of shares issued by the company. Right. So this is one more question about stock dividend. A 10% stock dividend was issued. The effect it would have on the following: the par value, retained earnings, and total equity. Yes. the par value would have no effect because stock dividends do not change par value per share. However, stock splits do. And retained earnings would decrease because it will get a debit and it will be transferred to other capital accounts, depending whether it's a large stock dividend or small stock dividend. In this case, it's a small stock dividend. So common stock and APIC also could get affected, but it's just movements within the equity section, debiting retained earnings and crediting common stock or APIC, or sometimes only common stock if it's a large dividend. So equity will have no effect. So this A itself should be the answer. Par value is never decreased with a stock split, a stock dividend. No effect is correct. Retained earnings decrease is correct. Total equity decrease is wrong because there is no change in total equity. So A is the right answer. Let's search for the next question. Something went wrong. Right, this is a very good question. If you read it carefully, it says that 20 million shares of $1 par is issued and outstanding. So there is excess paid-in capital in excess of par is also there, and retained earnings is also there. The question is asking by what amount the retained earnings is reduced when it is declared. Since it's a small stock dividend, 10%, it's less than 20 to 25% of the total shares outstanding. So it happens to be a small dividend. For a small dividend, the retained earnings is debited by the market value. So that is market price is $4. 10% of this is 2 million because it's a 10% stock dividend. So $4 into 2 million is 8 million. $8 million. So that is what retained earnings is debited. So D is the right answer. D is the right answer, but let us complete the entry. Credit common stock by the par value. Par value is 1. So 8 million, I'm sorry, 2 million is the par value. Since it is 2 million shares into $1, right? And the remaining would go to additional paring capital, 6 million. Dollars. This would be the full scope of the entry, but we have to answer only this part. You don't have to write the entry in the exam. This for just understanding. So D is the right answer. Let us go to the last question on this. This is a question on difference between stock dividends and stock split. Now, stock splits involve bookkeeping transfers. In fact, we can disqualify this option right away. Stock splits do not have a journal entry. Okay, so there's no transfers from retained earnings to capital stock accounts. But stock dividends do have that entry. Stock splits will not have. Stock splits are paid in additional shares of common stock. That is correct. No, that's not correct. In fact, stock dividends are paying additional shares of common stock, where stock dividends results in replacement of outstanding shares with new issue. Actually, the stock split results in replacement of outstanding shares with new issue of shares. For example, in a stock split, what happens if you have 100 shares? I used to invest in the time when there was no dematerialization. We used to deal with physical shares. I used to send this by courier, and if it's a 2-for-1 stock split, just to give me 200 shares. 200 brand new crisp shares. Okay, it has happened like that before during the time in the 80s when physical shares were traded. Paper shares. Okay, so this is actually the reverse. Stock dividends are additional shares of common stock, and stock split results in replacement of outstanding shares with new issue of shares. So C is the right answer. In a stock split, a larger number of new shares replaces the outstanding shares. Like I told you here, I couriered my 100 shares and I got 200 shares. So that's a larger number of new shares replacing my old outstanding shares. So D says a stock dividend results in decline in par value per share. A normal stock split would result in a decline of par value, not a stock dividend. So C is the right answer. So with that, we finished questions on stock split, stock dividends, cash dividends, and whatever to do with common stock. So in our next session, we would speak about preference shares. Hello, everyone. In this lesson, I'll be talking about preference shares and uh, uh, let's go to the text to discuss further. So the main difference between preferred stock and common stock is preference. That's why it's called preferred stock. It is given preference to claim to assets in a in case there is liquidation of the company. So in other words, if they have to distribute the assets of the company, they would distribute it to the preferred shareholders first and then to the common shareholders. So preference there. Preference in payment of dividends. So until the preferred dividends are paid, preference share dividends are paid, common share dividends cannot be paid. And how the dividends are calculated? Dividends are calculated on par value. Always it's calculated on par value for preference stock. Generally, the par value is higher than the common stock par value. So it'll be paid as a percentage of that, just like interest. It'll be a fixed percentage on the par value. And the common stock dividend would depend on the management's decision. It might be a per share basis as well. And another main difference is they do not have voting rights. So in other words, they cannot vote and they cannot participate into the company's decisions like common shareholders do. Right? So there are two types of preference shares: cumulative preference shares, depending on the dividends. Right? But both the dividends are calculated on par value. Cumulative is they're earned each year, even though it's not declared. And the arrears have to be paid before common shareholders can be paid. For example, I'll just give you an example for you. So suppose there is year 1, year 2, year 3, and we have got cumulative preference shares. This is cumulative preference shares of, let us say, 1,000, which gives you a dividend percentage of, let us say, 10%. By the way, the preference share holders, since it is more risky than debt, would have a higher return, right? Because it's equity, it's more risky. So suppose there was no declaration here. Okay, in year 1, they made a loss, they did not declare. And year 2, also they did not declare any dividend. So when they want to pay the common stockholders in year 3, they have to pay 30% dividend. In other words, the 100 here, 10% of 1,000, 100 here, and 100 here would accumulate. So these are dividends in arrears. All these are dividends in arrears. They have to pay this dividend. They have to declare and pay this dividend. And only after that, they can pay the common shareholders. Whereas, if it is a non cumulative preference shares, which is the next topic, it won't accumulate like this. If you do not declare, you don't have to pay. It's lost. So if you are declaring, if you want to pay common shareholders in year 3 and the dividends are preference shares are non-cumulative. So then you don't have to pay 300. You have to pay only this 100. For the preference shareholders, non-cumulative preference shareholders, and thereafter pay the common shareholders, right? This is in case of cumulative preference shareholders, if they are not declared, they are earned, but they are not shown anywhere as a liability. In fact, it would be footnoted. Journal entry is made only if the dividends is declared, which is debit to retained earnings and credit to dividends payable. So not dividends in arrears, which have not been declared and but have been earned, will not be recognized as a liability, but it will be disclosed in the financial statements, because it is contingent to something. That is, if the firm declares dividend, right? Or if the firm makes profits, or if they want to pay common shareholders, only then it will be declared. And it becomes a liability. So one more thing you should remember is there is no breach of contract if dividends are not paid to preference shareholders. But having said that, they have not invested for fun, they require a return. So if you continuously don't pay preference shareholders, the agreement would be such that it would trigger voting rights. So the company should be aware of that and have that in the back of their minds when they do not not pay preference dividends. So this is non-cumulative dividend. As I told you, it's lost if it's not declared. And the examination tip says here is, if the exam question does not specify whether preferred shares are cumulative or non-cumulative, usually they've specified, then to assume that it is non-cumulative. But anyway, you don't have to worry about that. They would specify that. And one more thing, yeah, just a minute. So I'll share you one more write up from the internet about preference shares. What's not so good about them from the investment point of view, investor point of view? They are mostly issued to companies and institutions, not to retail investors. So this is called privately placed. Privately placed when they sell it to institutions and companies only. For example, a company might sell their entire preferred stock to a bank. Okay, and the bank would prefer to invest in stock in preferred stock rather than to be bothered about fluctuating prices. Preference shares would always have a fixed price and it won't have a market. So that's the second disadvantage, right? It is not traded on the stock market. Companies, on the other hand, companies on the other hand would be preferring preference shares because it's not a loan. A loan has to be paid back, right? So preference shares is not a debt and it makes the balance sheet looks better, right? Because it is equity and not debt. The moment debt is there, the debt equity ratio goes up, the risk of the company goes up. So some companies would prefer to issue preference shares. They are not traded in the stock exchange, so they are not liquid. So this is the major disadvantage of preferred stock. They are privately placed, so you can't go to the stock market and sell it, right? Whereas on the other hand, equity shares prices go up and down. There's a ready market for it, right? And so basically, they have features of a bond in the sense it doesn't have to be paid back, but still it gives you fixed assured returns, just like fixed income instruments, right? And sometimes it would be, have an option to be converted to common shares at the if the investor prefers to do that. It's with the choice of the investor, right? So these are the some of the features of preferred stock. Sometimes you cannot say just because they are not traded in the stock exchange, it doesn't mean that you cannot sell them. Sometimes the companies would buy back preference shares after maybe 10 years or 20 years, depends on the agreement. Right? And common shares also can be bought back by the company as treasury stock. If the company chooses to do so, there would be a share buyback offer for common shares. So these are the main features of preference stock. In the next class, we would go into other components of equity like retained earnings and treasury stock. Hello, friends. This is another session of equity, where we'll be talking about, we'll be doing multiple choice questions on preferred shares. So let us go to the question bank. So this is a CIA question, certified internal audit questions. They are generally of good quality. Which of the following is not, he is bold-faced and not a feature of cumulative preferred stock? Cumulative preferred stock has priority over common stock with regards to earnings, which is correct. They have priority. They have priority over common stock with regards to assets in the event of bankruptcy. Cumulative preferred stock has voting rights is wrong. This is wrong, but this happens to be the right answer because this is not a feature of cumulative preferred stock. They do not have voting rights. If dividends are paid normally and there are not too much of arrears, then they don't have voting rights. rights. But it needs to be mentioned here that if you continuously do not pay preferred dividends, the agreement would be such that it would trigger voting rights. Okay, but normally it does not have. And cumulative preferred stock has a right to receive dividends in arrears before common stock holders can be paid their dividends is also correct. So actually, this is a good question to understand the features of cumulative preferred stock. So the A, B, and D are the features of cumulative preferred stock, and C is not. So you understand clearly the features of preferred stock here. So it's a good question, and C is the correct answer. Let's go to the next question. Yes, preferred stock and common stock differ in that failure to pay dividend on common stock will not force the firm to bankruptcy. That's correct. They are not obliged to pay dividend to common stock, while failure to pay dividends on preferred stock will force the firm into bankruptcy. That's wrong. Non-payment of preferred dividend is also not a liability. That's why it's not recorded. It's not a breach of contract. It will not force the firm into bankruptcy. Okay, so this is not correct. Stock dividends, common stock dividends are a fixed amount, while preferred stock dividends are not. This is the other way around. Preferred stock dividends are a fixed amount as a percentage of their par value. Common share holders' dividends are not fixed amounts. Sometimes they change from $1 per share to 0.5 per share, depending on management decisions. This is not the difference. Preferred stock has higher priority than common stock with regards to earnings and assets. In the event of bankruptcy is correct. That's why they're called preferred. They have preference over earnings and assets. In the event of bankruptcy. Preferred stock dividends are deductible as an expense for tax purposes. Wrong, because they are an appropriation of profit, not a charge against profit. while common stock dividends are not both the dividends, both are dividends, so they are paid out of after tax profits. They are not deductible tax expense. So this is not correct. C is the right answer. Let's go to the next question. So there's 8% cumulative preferred stock in a company that meets its dividends obligations. So they would have all the following characteristics except voting rights in corporate elections. Other things they would have. Okay, so dividends payments are not tax deductible. This is correct. There are no principal repayments generally for a cumulative preferred stock, but sometimes there is repayment after a certain period of time. The company would buy back the preference shares. Claim to superior, claim that is superior to the common shareholders. Yes, that's all correct. So this is not the characteristic of preference shares. Provided the company has met the dividends obligations. As I told you before, sometimes the company does not meet the dividend obligations for a long time. It could trigger voting rights among preference shareholders. Depends on the agreement. And also principal repayments depends on the agreement. Sometimes preference shares are redeemable, in which case they would be categorized as a liability and not as equity. This is again something familiar, what we have already done, right? What is it they ordinarily sacrifice? In preference of other things compared to common shareholders. They don't have the right to vote. Okay, so that is the thing they sacrifice. So the right to vote for members of the board of directors and in other matters requiring a vote, they have to sacrifice that right. All other rights are there with preference shareholders. They have the right to residual assets upon liquidation. in preference to common shares, and right for periodic earnings in the form of dividends, and also in case of cumulative preference shares, unpaid dividends would be accumulated. So A is the right. They sacrifice. They do not have the right to vote for the board of directors. So with that, we finished the MCQs of preferred stock. Next, we will speak about retained earnings. That would be in the next session. Hello, friends. Retained in the company from inception. So all the undistributed income of the company is in this account. It's a permanent balance sheet account. And the year-end income after taxes is close to the retained earnings account. See, the income statement would be made up of many temporary accounts like sales, cost of goods sold, and gross profit is not a separate account. It is just built into the income statement. And then there are separate accounts for overhead, several overheads, etc. These are all temporary accounts, and at year end, they would be transferred to the retained earnings. So retained earnings is increased by the net income, decreased by the loss, if any, and is also decreased when dividends are paid. Right? So it is going to be debited when dividends are paid, when both cash dividends and stock dividends are paid. When stock dividends are paid, it's going to be transferred transferred to separate accounts, like I discussed before. Separate paid in capital accounts like common stock and additional paid in capital account. We discussed about stock dividend in the previous videos. When cash dividends are paid, a liability is given rise. So debiting retained earnings and crediting a dividends payable. So that's what they mean here. The balance in the retained account represents all the profits of the company since it started, minus any dividends declared and amounts transferred to paid in capital accounts when stock dividend is declared. Right. So appropriated retained earnings. Appropriated is making use of the retained earnings for something. Right? So let us go and see what it says here. So when they're appropriating retained earnings, they are just making a reserve, nothing else. So to start off, everything is unappropriated. They are free retained earnings. We can it just means retained earnings available to be distributed to shareholders in the form of dividends. So you can distribute this unappropriated retained earnings. But sometimes the company does not want to distribute certain amount of retained earnings to as dividends. So that will be communicated to the shareholders. When they are reserving or appropriating retained earnings, they're keeping a reserve, as I told you. So what they're doing is keeping on the asset side, of course, when you create a reserve, it affects the asset side in the sense that certain amount of assets to the amount of the appropriation is not available for distribution. That's what it means. So appropriation of retained earnings is accomplished by a resolution which is approved by the corporate board of directors. So it may be a portion of or all of the retained earnings, which is appropriated or kept separately and not available for distribution of dividends. So appropriated retained earnings is nothing but retained earnings not available for distribution as dividends. What is it used for then? So it can be used for several things, what they are mentioned here. Creating a reserve to build a plant, some acquisition to reduce debt, right? To meet a bond requirement, maybe to pay a dividend, or I mean, maybe to pay back the bond, also meeting the requirement of a bond, or a restriction on the payment of dividends imposed by a loan covenant. One of the conditions of the loan might be that they should not pay dividend for some time, or they should not pay certain amount, exceeding certain amount as dividend, things like that, okay? And providing for R&D also. Any special marketing campaigns, reserve against unexpected earthquake losses, for example, and simply providing for the future. So once any of these are accomplished, it can be unappropriated. It can be available for distribution after that is accomplished. This list is not exhaustive. Of course, it can be for various other reasons. So when they appropriate it, it's debit retained earnings, credit appropriated retained earnings. But it will be all a part of equity. Appropriated retained earnings is not that it's going outside the equity band. It is within the equity. And then when the purpose is accomplished, you debit appropriated earnings and credit retained earnings. It's becoming unappropriated, in other words. Okay, but it's all part of equity. So basically, it's a communication to shareholders to know that the appropriated retained earnings will not be distributed as dividend, and they can have several appropriated retained earnings for several purposes. purposes. So when the shareholders read the annual report, they know that the retained earnings are appropriated for certain purposes. So that's about the theory of retained earnings and what you need to be knowing for the CM. So let us do some multiple choice questions pertaining to this particular topic in the next session. Hello, everyone. Hello, everyone. Welcome to the lesson on equity and retained earnings. And we will do some questions on retained earnings. Retained earnings were explained in the previous session. So we'll do multiple choice questions now. Okay, so this question asks you, what should be the current balance of retained earnings, right? So if you see, this is the total profit since its inception. So 840 minus 260, right? Which is the dividend paid, and fair value of a 20% stock dividend distributed. If you remember, if it is 20 to 25% stock dividend, 20 to 25% of the stock outstanding, if it's given as dividend, retained earnings is debited with the fair value. Okay, so this is the fair value. So minus 60. Now, excess of proceeds over cost of treasury stock sold. Now, when they sell, when they buy treasury stock, cash is going out, right? It's a cost. So cash is going out, and treasury stock would be not an investment, but a contra equity. I'll be coming to that in the next session. I'll be explaining about treasury stock. So when they sell treasury stock. It's like a profit. Proceeds over cost of treasury stock sold, but they won't call it profit. You cannot make profit with yourself. The company cannot make profit by selling its own stock, right? So excess of proceeds over cost of treasury stock sold will not be credited to retained earnings. I have not seen retained earnings being credited with anything other than income. But it can get debits, right? It can get debits. But so this will not go to retained earnings. It will go to additional paid-in capital. Right? It will be going to additional paid-in capital. So the retained earnings balance should stop at this. So how much is that? So 840 minus 260 minus 60, which is 520,000. So A is the right answer. I hope you try to do it yourself. Before looking at the explanation. So A is the right answer. So let us go to the next question. I will have to reshare it. I hope all of you can see this. So this question is asking, what is the total equity in its 31st December year 6 balance sheet? Okay, 1 second. I may have to redo it because there is something coming up there. Right. So the balance sheet. The total equity to be reported in the balance sheet. That's what it's asking you. So here common stock at par would be included as equity. Additional capital would be included. So we'll have to add this. Treasury stock at cost is actually a contra equity. It's actually a contra equity. So it's a debit balance. So we are going to, it'll be shown in the equity side. So it is a minus, and net unrealized holding loss on a available for sale security is actually a part of comprehensive income, accumulated comprehensive income, which is a part of equity. So it's a loss, so we have to deduct. Retained earnings appropriated. You have to add, even though it's appropriate, it's not going anywhere. It's a part of equity, as I told you when I was explaining about retained earnings. It just means that it's not available for distribution. These are available for distribution, 200. So all this has to be added. Whatever I have ticked has to be added. Whatever in brackets has to be deducted. So what would be the retained earnings? Do it in thousands, it would be faster. These small tips is very useful for you in the exam. So 600 plus 800 minus 50 minus 20 plus 150 plus 200 would give you 8. $1,680. So that is the right answer. I hope you got the concept correct. So with that, we finished. Speaking about retained earnings. In the next session, we'll speak about treasury stock. Hello, friends. In this class of equity, we'll be talking about treasury stock. So let's go to the text. And take it from there. So yes, they have given you the accounting standard codification on accounting for treasury stock. So treasury stock is what the company buys back after it has been issued to the investors. It is reacquired by the company, generally at a premium. Meaning, if the market price is $20, they might pay a little bit more when they're acquiring the shares. That has been the practice generally because they want to pay the shareholders money, right? They want to make them happy. So they would give them a little bit more even than the market price. So why do they do that? There are several reasons. Okay, the company may purchase treasury stock for a number of reasons. To temporarily provide a market for its shares, maybe maybe it's not selling so well, so the company buys it from the shareholders, right? And also, when they buy treasury stock, the market price jumps up a little. It might be temporary increase, but generally, because the shareholders know it is due to a treasury stock transaction, so a knowledgeable market does not place much value on the price rise of a company due to purchase of treasury stock. Okay, so anyways, they would also provide a temporary market for its shares to reconsolidate ownership. The meaning of this is suppose there is a hostile takeover, somebody is buying the company's shares. So the company themselves would buy their own shares so that it is not outstanding and not available for somebody to buy those shares for the acquirer to buy those shares. So they would also do that as an investment, but please note, when they say investment, it will not be accounted as an investment. It would be because it's not an asset, nor is it a liability or equity. It goes to deduct from the equity. It's a contra equity account. So it will not be shown in the asset side. It will be shown in the equity side with a minus sign. Okay, so as an investment, if the company thinks the shares are undervalued, okay, so the company might buy it and then wait for it to increase in price, and it will also be issued later on as stock dividend or to resell them for share-based payment. Instead of paying money to somebody, they would pay shares. And what is missing here out of these points is it's used in mergers and acquisitions. Okay, in M&As, it's used in mergers and acquisitions to purchase another company. So, for example, an acquirer, instead of paying the target company shareholders cash, they would pay them in their own shares. Okay, so for that, they would buy some shares and keep it in treasury. It has been found that in the past that a lot of mergers and acquisitions have been fueled by treasury stock transactions. That means companies have been purchased by giving the shareholders of the target company treasury stock. Okay, so there are many reasons for treasury stock transactions. This may not be the full list. So like here, I have told you it's not an asset. Nor it is a liability or equity. It is reduced from the owner's equity and that's why it's called contra equity account. Right? So the entire cost of it can be reduced. It can be put into an account called treasury stock and reduced from the equity, or it might be reduced from the equity by debiting the common stock account directly. Okay, so that can happen. It depends on the account. Accounting method used. There are two methods, the cost method and the par value method of accounting for treasury stocks. It's not included in the CMA LOS, learning outcome statements. Okay, so it's not detailed here. It will be taught to you in detail in other accounting courses like the CP. For example. Right. So now let us look at the classification of shares. Authorized shares of course, treasury stock transactions would be mentioned in the notes to the financial statements. Okay. Okay. So now authorized shares are the maximum number of shares the company can issue. They have the license to issue that many authorized shares, which is actually initially specified in the company's charter or articles of incorporation. Right? So, one thing to be noted is it's not affected by stock dividends. That means if the issued and outstanding shares are given stock dividends or stock splits or treasury stock transactions have taken place, the authorized shares would not be affected at all. But if as a result of a stock split or a stock dividend, etc., the number of new shares issued would be more than the authorized shares, then an amendment may be necessary to increase the authorized shares. Authorized shares do not split also. Okay. So if at all an increase is required, the articles of the company of articles of incorporation has to be amended with a shareholders vote to that effect. What are issued shares? From the authorized shares, whatever has been sold to the investors are called issued shares. The issued shares can be increased by stock splits and stock dividends as well. The number of issued shares would not be affected by treasury share transactions. That means if the company buys some shares, let us say that the authorized shares, let me just give you an example. So authorized shares, a simple example is 1,000 shares. Okay, out of this, issued, let us say they issued partly, they issued 700 shares. Okay. So then 700 shares are issued and outstanding. Okay, issued and outstanding. That is with others. Then let us say there's a treasury stock transaction of, let us say, 50 shares, right? Then the outstanding shares is now 650. 650. This is now issued. This is now the new issued and outstanding. The new issued and outstanding would be 650 shares. So now the old one, I should remove the outstanding part because 700 is not outstanding, but 700 is issued. So that 50 treasury stock does not affect the issued shares. That would remain the same because it's issued, but the company has purchased it back. Okay, so the outstanding share is what is the shares with outsiders, not with the company. So that's 650. I hope with this you understood the whole thing, right? And the issued shares are okay. So the treasury stock transactions will not receive any dividend. Okay, so they would not receive any dividend. Outstanding shares, as I told you, it's currently owned by other parties, and the number of outstanding shares can be increased by stock dividends, stock splits, can get decreased by treasury share transactions, because unless the treasury shares are issued again, resold to investors, then the number of outstanding would go up again. So here's a nice little table. Authorized shares will not get affected by stock dividend or stock split or treasury stock transactions. That number would remain the same. And issued will get affected by stock split, stock dividend. Okay, but it will not get affected by treasury stock transactions. Okay, and outstanding would get affected by all stock split, stock dividend, and treasury stock transaction. That number of outstanding would change. Right? The number of issued would change for stock split and stock dividend, but not for treasury stock transaction, because that remains issued. Treasury stocks will not receive dividend. They cannot vote because it's not with other people, it's with the company itself. It's not classified as outstanding. So treasury stocks are issued but not outstanding. If they're resold again, it becomes issued and outstanding. Simple. Treasury stock held by the company is the stock that is authorized and issued but not outstanding. The same thing. The stock that has been retired by the company. Now, what is retired? Retired by the company means it's cancelled by the company. It's made null and void. For that, the company has to buy it, buy it by a treasury stock transaction from the shareholders, and then cancel it in the sense it doesn't have an intent to reissue it. So actually, the common stock and the related APIC accounts would be debited, and treasury stock would be credited. So that way it will get cancelled. So the stock has been stock that has been retired by the company is authorized, okay, but it's not issued. And it's not outstanding. So thus, treasury stock and retired shares are authorized and not outstanding. The difference being that treasury stock, the difference between treasury stock and stock that has been retired is that treasury stock is included in the issued shares, but it's not outstanding. Okay. Whereas retired stock is not even included in the issued shares. It's unissued shares, right? So that is what it means. So that's about treasury stock, right? I didn't see any specific questions on this. So if you have, since they are not into it, not into the accounting of treasury stock, I don't think it'll be tested too much, except about, you should be familiar with this table. Like what gets affected, you might get a multiple choice question on that. So let us go to with that we finished equity. So in the next session, we will be discussing revenue recognition. Hello, everyone. Welcome to the class. Class on revenue recognition. So in the last class, we finished equities. The next topic is revenue recognition. Let us take a tour of the text. So basically, it's all based on the new standard accounting standard codification 606. Okay, so the guidance is here. The objective is to have a single comprehensive uniform revenue recognition model, which can be comparable across industries, jurisdictions, and capital markets. So what is this principle? It's basically principle based. The new standard is principle based rather than rules based. That means it depends on the judgment of the particular management, but it should be applied consistently. So this revenue recognition model actually would recognize revenue if in the period in which the performance obligation is satisfied. So when is it satisfied? When basically the risks and benefits of ownership is passed on to the customer. That is, the customer obtains control of the assets or service transferred to him. Therefore, the revenue should be recognized for the amount which the company is entitled for the exchange for those goods and services. Right. Then, as I told you, it is principle based. It can vary based on the judgment of the management for specific situations, but it should be applied consistently throughout the company and throughout the units of the company. It should not vary due to the judgments of individual accountant or operating units within the company. So what are contract assets and contract liabilities? Actually, the revenue model now focuses on recognizing revenue when control transfers to the buyer. The model is asset and liability based. Okay, what does that mean? We will see further. Contract assets are unconditional. That is, the payment has to be received. There's no conditions for it because the performance has been satisfied. So basically, that unconditional contract is called accounts receivable. So you debit accounts receivable by the amount of sale, credit sales revenue. At the same time, a debit to cost of goods sold and credit to inventory because inventory is going out. So basically, if you have sales as 100, accounts receivable will be 100. Along with this, VAT entries also would be there, which they have not shown you. And let us say this is 80. Cost of goods sold, inventory going out is 80. So in your income statement, you would have, when you build up the income statement, you would have sales from the sales account. Which is 100. And COGS, which is a debit amount. Sales is a credit, COGS is a debit. So it would be 80. And the gross profit is built into it. So you don't have a separate account for gross profit. I hope that's clear. So now let us see what is the unconditional asset. Unconditional assets are when one of the conditions are yet not satisfied, but the performance has been performance of obligations has been complete. So for example, if there are two contracts, A and B, and A is complete, but payment the company is not entitled for payment until B is also complete. So since A is complete, the company recognizes a contract asset. So debit contract asset with the price obligation of A and take it for sales. Take sales and the related cost of goods sold at inventory also is being passed if it is goods sold. Otherwise, service means it will have only this, right? And then when the company completes B also, then what would happen? They can invoice the customer. Right? It becomes unconditional now. First, the contract asset, which they recognized here, was conditional. This is conditional contract asset because B is not yet complete. Now this is unconditional. Where B is completed. So A and B both are invoiced to the customer. Okay. And then you will credit this contract asset A, and you will recognize sales for only B because A has already been recognized. Sales revenue for A has already been recognized. I hope you understand that. And we will do multiple choice questions which would cement this concept. Now, what are contract liabilities? It is a liability because the company has not performed the obligation. Performance obligation is not complete, but they receive money or consideration from the customer before that. So what they do, they don't take it to sales directly. That would be totally wrong. They cannot take debit cash, credit sales. So they would debit cash and keep it in the balance sheet as contract liability. Once the performance obligations is done, satisfied, you debit this contract liability. So debit and credit would cancel and recognize revenue. right? And in the meanwhile, the time you recognize revenue, you can recognize cost of goods sold for a proper matching of expense with incomes. So debit cost of goods sold, credit inventory as it's going out. The name of contract assets and contract liabilities might differ depending on actually, this happens in long-term contracts where the contract liability is called BCA, bills on construction account. Okay, and contract assets is called CIP, construction in progress account. So they would have different names. But it should be clearly distinguishable between unconditional contract assets and conditional contract assets. That's all it means. So that's about contract assets and contract liability, but the main heart of the revenue recognition chapter or standard are these 5 steps. I would explain this in the next session. Hello, friends. Welcome to the lesson of revenue recognition. So in the last session, I spoke about contract assets and contract liabilities. And now I'll be speaking about the most important part of the revenue standard, which are the 5 significant steps, the 5 criteria to recognize revenue. So let us go to that. So 5 steps for revenue recognition. The new revenue recognition standard includes these 5 steps. Previously, it wasn't specified in this manner. So first is to identify the contract with a customer, identify the separate performance obligations in the contract, determine the transaction price, allocate the transaction price to separate performance obligations. If there's more than one performance obligation, and recognize revenue when each performance obligation is satisfied. So that's the main thing, to recognize revenue when performance obligation is satisfied. You can find some kind of a memory aid to remember this. Maybe C for contract, identifying the contract. O for performance obligation. T for determining the transaction price. A to allocate it to separate performance obligations if there's more than one, and R is to recognize revenue, something like Kotar, something like that. If you have a better memory aid, all the more good, right? But something, because they might ask you this in a multiple choice question, saying that, you know, something like all the five are the steps in recognizing revenue as per the new standard, except one, something like that, you know. So it's better that you memorize this. And most of it is by common sense, so you don't have to really put too much pressure to memorize this. So identify the contract, identify separate performance obligations, more than one, determine the transaction price, allocate the transaction price to the separate performances, and recognize revenue when it is performed, right? And sometimes a particular transaction might not require all the 5 steps. For example, when you sit in a taxi, there is no need to identify a contract because it's implied, right? There is an understanding that once the taxi guy uh, probably once a taxi guy drops you to your destination, you need to be paying him. So it's implied, even though it's not orally or written. Mentioned. Okay, so this step is already implied. Okay, and there is no separate performance obligations. There's only one obligation to drop you to your destination. I'm giving it to the example of a taxi ride. Okay. And yes, the transaction price is determined later by the meter. You don't need to allocate any transaction price to separate performance because it's only one. And yes, you have to pay the person and then they would recognize revenue once they drop you. Okay. Suppose if it's a taxi company, that's what they would do. So once the performance is obligation is done, they would recognize revenue. Now, identifying contract. We are going to look at it separately. So a company should account we can go directly to identify the contract. What does a valid contract what a valid contract should have? Okay, so that is one. These are the things which you should do, and something are excluded from this definition of contract because uh, it's it's accounted a little differently. For example, leases. Insurance contract and financial instruments like investment securities, derivatives, and also non-monetary exchanges. Okay, so they might be outside the scope of topic 606. Okay, right. So then an agreement would be when it creates enforceable rights and obligations, and it meets all of the following criteria. Now, it's quite important that you remember these criteria. So let us just go through it. Part of it is common sense. Right? Parties have approved contract. It can be oral or in writing or need not be anything. It can be implied by other like by customary business practices. Like as I told you, the taxi ride. You're not going to tell him that you drop me and I'll pay you. Okay, you will not even tell that when you sit into that taxi. It's all understood, right? The rights of each party regarding goods and services can be transferred and to be transferred can be identified, right? You should be clearly identifiable what should be done. Payment terms should be identified. Payment terms should be identified. Contract should have commercial substance, means it should not be just equal give and take. Right? So there should be some kind of change in the future cash flows of the company because of the contract. And it is probable, this is very, very important. It is probable that the company will collect the money. So for that, they have assessed the customer risk and the customer's ability to pay. Now, what is probable? Probable is a 75 to 80% probability that the person would pay. See, when it's probable, only then you get into a contract to recognize revenue. Right? If there is some doubt about this collectibility, then you shouldn't be entering into the contract. Now, you cannot tell 100% that you would receive payment. Some things can go wrong in the middle. So if there is 70 to 25 to 80% probability, you have a valid contract, right? And after that, if things go wrong, you have to create provisions or allowances for credit losses, right? So one thing to note, a valid contract is to be accounted under Accounting Standard Codification 606 only if it creates enforceable rights and obligations in both the parties and meets the 5 criteria or conditions above for a valid contract. Okay, so that's what we have noted here. Right. And further than that, performance obligations can be satisfied at a point of time when the goods are handed over, and or over time. So all is not recognized at one time. It is recognition of revenue is recognized over a period of time. Okay. So, for example, when a customer approaches a cashier in a retail establishment and pays for it, the contract is satisfied at a point in time, right? Sometimes it can be long-term contract. So when the contract takes many years to complete, for the performance obligation to complete, the company performing that could either recognize it at a point of time when the contract is fully completed, or it can recognize it over time. Okay, when it's taking extended period, but the customer obtains control of the asset and improvement is being done, or asset has been constructed after the customer has obtained control. So in that case, the performance obligation in the contract are satisfied over a period of time, and revenue is also recognized over a period of time, right? Then there's to identify separate performance obligations. Okay, so if one performance or goods or services distinct from the other, you have to separate the performance obligations to be done, because revenue recognitions would be done based on the completion of these performance obligations. Okay, so determining the transfer price. for the full amount. So for all the obligations. For example, it could be a variable consideration. Okay, variable consideration means you can put an estimated amount in the contract, but it might vary compared to the contract because you might give a price concession or some kind of a bonus. Or maybe the supplier is entitled to some kind of a performance bonus, etc. So how do you account for it when it's uncertain? There's slightly variable consideration, right? So you take the expected value. Expected value is nothing but the average by taking the probabilities of what you would be able to collect and most likely amount over a range of possible amounts. So that would be entered in the contract. And then later on, adjusted accordingly. Right? And then right. Significant financing components. Now here, this is important to know that if the consideration or the money to be received from the customer would take more than a year, then present value of that amount should be taken. So that's what they say. It should be adjusted for time value of money. And the revenue amount, what you would recognize is the present value of the amount to be received. And the interest income would be recognized over the period, over the financing period, or over the period the customer is going to pay. So first, the contract revenue will be recognized recognized when the performance obligation is satisfied. And what is that amount? It is the present value. If it is going to be received for more than a year, okay, greater than a year, right? So that revenue amount would be the present value of the consideration discounted at a interest rate which signifies credit risk, inflation, etc., right? Which to take into account credit risk, inflation, etc. And the interest income would be recognized when the customer pays over the period of financing. So this is how the transaction price is determined. That is the third condition. The fourth is to allocate the transaction price. Okay, non-cash transaction. Before that, non-cash transaction. Suppose they are paying for items other than cash. The fair value of that non-cash transaction should be taken. Okay, suppose they're getting, instead of money, they're getting something like labor or material, etc. Then the fair value of that should be considered in the contract, and allocate a transaction price to performance obligations if there are more than one performance obligation. He has given an example here. Suppose the first performance obligation is to deliver the goods at shipping point. So FOB shipping point, that would be the first performance obligation. And thereafter, it is in the control of the customer. The risks and benefits have been transferred to the customer, and the customer still wants that shipping and handling activities to be performed by the company after the customer obtains controls. Then and that would be the shipping and handling activities would be the second performance obligation. And the sales price should be allocated to the goods which was delivered at shipping point and the shipping and handling activities separately, right? So the transaction price should be allocated to both these activities, and revenue recognition should be done after each of these activities have been satisfied. The performance has been completed for each of these activities. So then comes the final step. This is an example for that. Then there comes the final step, which is revenue recognition after each obligation is performed and the customer obtains control of the asset. When does the customer controls of has control of an asset? When all the risks and benefits are transferred to the customer. The customer can direct the use of the asset, and as he told you, obtain substantially all the remaining benefits of the assets and the risks associated as well. So that is when the customer obtains control of the asset, and that is when revenue recognition has taken place. So I will show it to you with a very, very simple example, all these 5 steps. Okay. So once you identify the contract, let us say there's a contract to perform A and B. All those criteria for the contract has been satisfied. It's not outside the scope of 606, right? So these are the 2 conditions, 2 jobs to be performed. So the contract is identified. Okay. Then the performance obligation is identified. So we are talking about COPTAR, is it not? And then the transaction price is determined. Let us say the transaction price is determined to be 150. And the individual transaction price, let us say it is 100, 100, and let us say for this one, it is 80. Okay, just for example. The full transaction for A and B together is 150, but the individual standalone prices for A and B is 80. Okay, so you determine the transaction price. Now you have to allocate the transaction price between A and B. How would you do that? Okay, so I'm assuming there are two obligations. So you would take the total 180 and allocate it. 100 divided by 180 into 150. So proportionate allocation. So 100. So this one would be allocated 100 divided by 180 into 150. So how much is that? 100 into 150 divided by 180. So it is for the first one, it is 83.33. It has to be less than this because the standalone prices are more. And the other one is 150 minus 83.3333. So it is 66.67. And just make sure that it comes to 150. Right. Right. So it should come to the total transaction price. So, okay, your transaction price has been allocated. Okay, the special transaction prices I've shown you in the text, that if it if you have to receive it after a year, then you have to take the present values. And for non-cash transactions, you have to take the fair value of the non-cash transaction, etc. Then you would recognize revenue when each of these are performed. So when A has been performed, you would recognize 83.33. When B has been performed, you will recognize 66.67. So that in a nutshell are the 5 steps for revenue recognition. remember quotar. Or if you have a better memory aid, go ahead and put it. It should suit your memory. Rather, this suits my memory. I can remember it because of quotar, but you can use anything which is good for you. So we finished for the moment studying about contract assets and contract liabilities and the 5 steps as per the new standard for revenue recognition. In the next class, we would do multiple choice questions. Hello, friends. Welcome to the lesson on revenue recognition, and we will be doing multiple choice questions on the topics that we have so far done. So let me share the screen. So the question says, under the new standard 606 of revenue, recognition of revenue does not occur until cash collection is not the criteria because the performance has to be completed. There is one choice saying performance obligation has been satisfied. Don't be in a hurry to take that. Just see if there is anything else which is more better. Entity has to have a signed binding contract. It's one of the steps. For revenue recognition. But when does revenue recognition actually takes place? When performance obligation is satisfied and is probable that the company will be able to collect substantially all of the considerations. So that is when and it should have a violate contract also. See, at the time when we identify the contract, we would see we would look into the collectibility as well. But by the time the performance obligation is done, the situation might have changed. So even the collectibility whether the money can be collected by the company. That also should be looked into along with performance obligation completion before revenue is satisfied. So B is the right answer. By probable, they mean a 75% to 80% chance or probability of collection. So the company can recognize revenue, and after that, if the customer doesn't pay, then they have to provide, they have to make an entry for credit loss, allowance for credit loss. So B is the right answer here. Even though D is close. So this company says that this question says that on May 28th, pause it and try to do it yourself. I'm getting on with the explanation. On May 8th, Markal company purchased from Air Ahrens is the supplier, Markal is the customer. They must purchase a tooling machine for $1 million, payable as follows: 50% at the transaction closing date. That means when the transaction takes place. Okay, so that's on May 28th actually. So 50% is due then, and the other 50% is due on June 28th. Their fiscal year is May 31st. These are the things you should note. Okay, so June 28th, the next installment is due in the next fiscal year. The machine's cost to Ahrens is 800,000 and Markal paid 500,000 at the transaction closing date and took possession of the machine. Transaction closing date is May 28th. Half of 1 million was paid. On June 10th, now this is following the next year. Okay, it's following in the next year. Ahrens determined that the change in business environment has created a great deal of uncertainty regarding the collection of the 500 balance due from Markal, which was due on 28th of June, and the amount is probably a credit loss. Aaron's fiscal year is 31st May. The revenue recognized by Aaron's, who supplied the machine on May 28th, is what? Now see, where Aaron is concerned, the performance obligation is complete and collectibility was probable as of May 28th. Later on June 10th, things changed. So for that, he should probably create a allowance for credit loss. But in the fiscal year end, May 31st, as of May 28th, collectibility was reasonably certain. Performance obligation was completed, so 1 million should be recognized. Nothing less than that. Situations changed on 10th of June, then you have to create a provision for credit losses. In the next fiscal year. So that's the answer for this. C is the answer for it. Let's go to the next question. This is an interesting question. Read it, pause it. And then try to answer. So the calendar year is 31st December 2005. That is their fiscal year also, right? So that looks like the fiscal year. And what has happened? They have received 90,000. A 3-year subscription to a multi-publication beginning April 1st, 2005. I'll call it 2005. And properly recorded this consideration received as contract in the contract liabilities account. What would it be in the entry? It would have been debit cash 90K and credit contract liability. You can name this anything you want. properly. So this is how it was entered. So contract liability has a credit balance of 90,000. This is of unearned revenue. So assuming that he records adjustment only in the year end, calendar year end, the adjusting entry to reflect proper balance in the accounts as of 30. December is actually 9 months. From April 1st to 31st December is 9 months income he should take, considering that the monthly publications have been done, the performance to the contract has been done. Nothing is mentioned that it has not been done here. So we take it for granted that from 1st of April 2005 to 31st of December 2005, whatever performance in form of monthly publications had to be done was done. So how much to take income? 90,000 divided by 36 months, because it is a three-year publication. So 90,000 divided by 36 is going to give us 2,500 per month. So 2,500 into 9 months. 9 months. How is 9 months? From April 1st, to December 31st. So 9 months. So that would be into 9. $22,500. So what we should do is we have to debit contract liabilities for 22,500 and credit subscription revenue. This hits the income statement. So D is the right answer. And thereafter, the contract liability account would have a balance of 90,000 minus 22,500. Which is 67,500 would be the contract liability balance. for the balance sheet purposes. So the other ones are obviously wrong. This is obviously wrong because you would not be debiting subscription revenue. The others are entry-wise correct, but amount-wise wrong. So D is the right answer. The first one is wrong in the entry itself and the amounts as well. Okay. So let's go on to the next question. So let's go to this CIA question. The practice of recording consideration from a customer before the obligation has been satisfied as a contract liability is an example of the revenue recognition principle. I have explained about it when we were discussing contract assets and contract liabilities in the previous class. And yeah, that is one. And then let us talk about the next question now. Right. Now this one says, an airline should recognize revenue from an airline ticket in the period in which actually the closest what comes to for revenue recognition of performance obligation satisfaction is the related flight takes place. Not when reservations are booked, not when the ticket is issued also. The ticket issued is still the company, the airline has not completed its performance. It has collected the money. Okay, so when the related flight takes place, that is when it should recognize revenue. Anything before that, it would be like as many a slip from the cup to the lip, they say, right? So until the performance is done, the airline should not be recognizing revenue. So D is the right answer. Yeah, there are many other questions. We would do this in the next sessions after we learn more about revenue recognition. There are still many concepts to be learned, and after that we can attack more multiple choice questions. Hello friends, welcome to the class on revenue recognition, and in today's class we will talk about some special conditions for revenue recognition. So let us go to the text. Right, so the conditions, special situations are for the CMA exam, basically, it would be contract with a right to return, consigned goods, and long-term contracts. Right? So first of all, we'll talk about contract with a right to return. So here, oops. Let us look at what the text says. In fact, they are describing the way it should be accounted when it has a right to return. That means a customer, once he takes the goods, and if there is any fault in it, he has a right to get a full refund or a replacement of the item. Right? And the period for which he would be eligible eligible to return would be mentioned in the contract. In such cases, the contract consideration is variable. What do you mean by variable? That is, it can vary from what is mentioned in the contract based on some clauses mentioned in the contract. Okay. So this entire part gives you the way it should be accounted. So if you read this without an example, it's not going to be very clear. So I would explain this part, the accounting part, with a relevant example. For that, I'll go to the whiteboard. Okay, so let us assume that there's a company called Y, which sells 100 widgets. Okay, sells 100 widgets at $10 per widget. Which gives you the contract price of 1,000, right? And internally, let us assume that the cost of this 100 widgets, let's assume it to be 5. So that would give us $500 is the cost. Right? And this is the sales, total sales price or total sales consideration. Now, let us assume that the company expects 3% of widgets to be returned. So estimated %3 of widgets to be returned based on previous experience. Right? 3% of the widgets to be returned based on previous experience. So let us say this and within 60 days. Right? The period of return is within 60 days. After that, the company can recognize the revenue. Okay, so that is about how it should be. Let us say this transaction took place on 1st of December. So what you would do is debit cash or AR, depending whether it's a credit sales or a cash sales, for the entire 1,000, the gross amount. But credit revenue only for that amount revenue or sales only for that amount which the company expects to be received. So basically, it would be 970 because 3% of 100 is 3, right? So that part can be returned. So what we are accounting here is 97 widgets into $10. Okay, and then credit refund liability, which will be a part of current liability because this three into 10 can be returned, for which they have to pay. The company would have to pay. Okay, so that's why resources can go out. Maybe there'll be a cash refund. So it is 3 into 10. Right. Now, at the same time, they would be cost of goods sold as well. So debit cost of goods sold 485. How did we get 485? It is 97 widgets, because 3 is expected to return, right? 97 widgets into $5. I hope the math is right. 97 into 5 is 485. Okay, and debit refund asset. So this is all as per the accounting standard codification 606 for sales returns or for contracts with a right of return. Okay, so that would be how much? 3 into 5. Right? 3 into 5, which is 15. 3 into $5. And you'll credit inventory for the entire amount because everything is going out. This will be shown in the current liability side, and the refund will be shown in the current asset side because you can expect to sell it if it is not refunded. Okay, so here we are going to account for the entire $500, which is 100 widgets into $5, because that's what you're delivered. Okay, that's what you're delivered. Now there's a proper matching of revenue with expense, which is 97 and 97. Refund asset and refund liability, the standard says not to net it off, but some companies do net it off. Okay, some companies shows the refund asset along with inventory. Some companies show it separately. The standard has not specified how you should be doing it. Okay, so now this is how the accounting is done. Now let us say on 31st of December, I'll go to the next page. On 31st of December, one item is returned. One widget is returned. So what will be the entry? One widgets sales price is, you remember, it is $10, right? So debit, you kept the refund liability for that only. Debit refund liability with this $10. That is one widget into $10, and credit cash or AR for this $10, right? And then the inventory comes in if he has returned it. The inventory comes in. So debit inventory, how much? $5, which is one widget into $5, the cost, remember? And credit refund asset. Which is $5. Okay, so that would be the entry. Now remember, refund asset, refund liability. I'll put like this: refund liability had a balance of 30, if I'm not mistaken, 30, and 1 is returned. So by cash, you pay of this 10, right? Right. And then, so there's a 20 balance credit here, and refund asset, which will be shown in the current asset side, had a balance of 15 debit. Okay, by inventory. It got a credit of 5, and there is a balance of 10 debit. Okay, so now let us say 31st Jan. When it expires, there's no more returns. Okay, after this, there are no returns, no more returns. Okay, so 31st of Jan, the 60 days expires. The right to return expires. Okay, so then what do you do? What do you do? You have a credit balance here, right? In refund liability. So you debit refund liability. You can now recognize it. Okay, 20, and credit sales or revenues 20. Okay, and debit debit cost of goods sold, this 10. And credit refund asset 10. So you have got the sales and the cost of sales to match, and it's recognized when the period of return expires. So COGS, you will get it 10. So this account becomes 0. And sales, you will get 20. So this account becomes 0, 0, end of story. So this is how the entire accounting is done. So if you have seen this, you don't have to bother reading the text about how to account for it. If you get an idea of how to account, this is how it is. Accounted. You can look at the first page And the second page to get the full idea about how to account for contracts with a right to return. Right? So that's all about this. We will see if there is multiple choice questions, we would do it. Otherwise, we would go to the next topic. Hello, friends. In this class of revenue recognition, we would talk about consigned goods and their accounting. So let's go to the text. Right. So what does consigned goods mean? It means that shipping of goods by an entity or a firm to a distributor. But that shipping of goods is only for the consignee who receives the goods to sell it on behalf of the consignor, the company which is sending the goods to the consignee, right? So the entity or the company would be retaining control of the goods until the sale happens. Because control has not passed to the consignee who is receiving the goods, the consignor who is sending the goods does not recognize revenue upon shipment or delivery to the consignee. It's understood because sale has not taken place. It's only in a different location. The goods are in a different location. Okay, so the consignor will recognize revenue for the entire selling price. This is very important. For which the consignee sells the goods, even if some commission is paid to the consignee. The consignee is entitled to a commission, right? So the consignee recognizes any revenue by means of a commission. So consignee's revenue would be commission, okay? And the consignor would treat that commission as a selling expense. Let us look at the journal entries, which is very clearly put in the text here. So let us look at it. Only thing, there are no numbers, but it doesn't matter. You can understand it clearly. Now, accounting in the book of the consignor, when he sends the good on consignment, you can name it goods out on consignment, the original cost. Credit inventory, okay? Because inventory is going out, but it is good on consignment. These goods out on consignment will be shown in the inventory band itself. So freight cost incurred by the consignor to transfer the goods to the consignee are inventoriable cost. What do you mean by that? It will be included in the cost of goods sold or in the inventory and eventually in the cost of goods sold. So you would debit cost out on consignment by the freight cost and credit cash or the supplier of the freight and then the consignor would now make an entry only when the sale is made by the consignee and cash is transferred to the consignor by the consignee. So debit cash, debit commission expense, debit cost of goods sold, credit revenue from consignment sales with the full cost and credit goods out on consignment. Let me just split this entry. Okay, so let us say if the revenue was 100, okay, so you would debit cash for 97, okay. And debit, because only 97 will be given by the consignee. Debit commission expense 3. And credit revenue from consignment sales. Okay, that is B100 full amount, right? That will be the full amount. And then you would debit cost of goods sold. Let us assume that cost of goods sold was 50, was 75. For this 100, the cost of goods sold was 75. And credit goods out on consignment. Because that is what is sold. On consignment, 75. So this would be the entry if I put some imaginary figures, right? Now, let us look at the consignee's books. So this is the consignor's books. Now let us look at the consignee's books. He would debit cash for the total amount received. Like I told you, if he has received from the customer 100, he would debit that. Credit payable to the consignor, 97 only he's going to pay. You saw the corresponding entry of 97, cash. And debit and credit commission 3. This is going to be revenue for the consignee. And debit payable remitted to consignor, he will remit to the consignor 97 and credit cash 90. So what is that to remember here? That the revenue recognized is equal to the total sales price. Commission should be accounted separately as an expense and not a reduction from revenue from sales. That's all you need to be knowing about consignment. consignment accounting. You would be tested on this. Sometimes they test a lot on consignment accounts. Okay, so that's all it is. All about for the CMA, right? So in the next session, we will go to the other special accounting, which is long-term contracts. And that's a long explanation. Hello, everyone. Welcome to another lesson on revenue recognition. And in this class, we'll do some multiple choice questions on what we have studied so far. So let us go to the question bank. Yeah. So here, DEF is the consignee for 1,000 units of product X for ABC company. So this is the consignor who is sending the goods. Okay. And ABC should recognize revenue from this 1,000 units when? When the agreement is signed? No. And ABC ships goods to DEF? No, because the control has not been transferred anywhere. A control is still with ABC. Only the goods are in a different place. DEF receives goods from ABC? No. Control is not transferred. Only he receives it on behalf of ABC. Then DEF sells the goods and informs ABC of the sale. That is when actual sales takes place. And control is transferred to a customer, and ABC can recognize revenue at that time. So D is the answer. It's a relatively simple question. I don't expect you to get too difficult questions on consignment accounts. Let us go to the another question. Right. So in this question, it's asking you how much revenue does the company recognize for the year end? So pause it, try to do it yourself. One thing should be noted here is products sold to the wholesale customers are shipped FOB destination. That means control is with the seller until it reaches the customer's destination. So until it reaches the customer's destination, the seller, which is IER Corporation, cannot recognize income. So now he's asking, as of 31st December, how much revenue will be recognized? Let us say the wholesale products shipped on 20th December. If it was FOB shipping point, you could recognize it on 20th itself, but it was received on by the customers, as I told you, FOB destination. It was received by the customers on 31st December. So this can be recognized because it is FOB destination and received on 31st December. Products shipped on 31st December but it's received later on. No. If it was FOB shipping point, it would have been recognized. But since FOB destination, no. Wholesale products sold on 30th, but shipped on Jan, received maybe even later, so certainly not. Wholesale products on consignment is not a sale unless the consignee sells it and informs the company that it's been sold. Nope. And in-store sales is already sold and control has been transferred, you would recognize that. So totally, it's going to be 105,000, the revenue to be recognized as of 31st December in the year mentioned. So the answer here would be B. B is the right answer. We will be doing more questions in the coming sessions. And also, we would also learn about long-term contracts in the next video. Hello, friends. Welcome to the lesson on revenue recognition, and now we are going to study about long-term contracts. Let's go to the text. So accounting for long-term contracts is going to be a little bit different than the accounting what we have been doing so far. So under accounting standard codification 606, sometimes it takes time for the performance obligations to be complete, right? So in some cases, the the customer obtains control of the asset at a point of time, usually when all the performance obligation has been satisfied, even though it requires time to perform. Maybe it took more than a year to perform, but he would get control once the full performance obligation is performed. So that is called point in time. Okay, so he will be the company will be recognizing the revenue point in time in this case. Yes. Right? But sometimes sometimes, like for this happens mainly in long-term construction contract. Sometimes the customer obtains control as and when the performance is being completed. So that is the time the company can recognize the revenue over time. It doesn't have to wait until all the performance obligations has been completed. It can recognize revenue while it is being completed. Not after. Basically, in a nutshell, if the company recognizes revenue, cost, and profit, after the performance obligation is complete, even though it takes a longer time, then it is called point in time. And if the company recognizes revenue, cost, profit, during the performance of the contract, during not when it is completed, during, then it is called recognizing revenue over time. So these are generally long-term contracts and takes more than a year to complete. So here, a very important thing you should note, that a company satisfies a performance obligation over time over time, over a period of time, that's what they mean, and recognizes revenue and cost over time if at least one of the three following at least one of the three following criteria is met. What is this criteria? Customer simultaneously receives and consumes the benefit provided by the company's performance as the company is performing its obligations. He has given you an example. Annual maintenance contracts such as office cleaning, etc., wherein the customer would be billed on a straight line basis, a fixed amount every month, and the company can recognize revenue on that, because the customer is continuously consuming the benefit of that service. Is on a straight line basis, they would be recognizing income and revenues. The second one is the company's performance creates or enhances an asset such as work in progress that customer controls as the work is being done. For example, here, a contract to build a structure on a land. A customer owns the land. So customer is in charge or controls the asset as the work is done. So in that cases, as and when the work is completed, the company can recognize revenue. However, invoices for progress payments may not have any connection to revenue. They cannot recognize the revenue, what they're invoicing. For the amount they're invoicing, because that might be some advance payment sometimes. The company may, the customer may need to pay something upfront. So it doesn't mean that the company giving the service or building the structure in this case can recognize that advance given by the customer immediately. So there's no connection between the progress payments and revenue recognition. Revenue recognition recognition in this kind of cases would be done as and when the customer, as and when the obligation is performed. By the percentage it is performed, by the stages it is performed. I'll give you an example. Suppose there's a big land here like this, owned by a customer who already has a house here. Okay, and he wants fence to be put. Right? So this is the second condition. Exactly, because it enhances an asset. So as the contractor is putting the fence, to keep away wild animals or whatever. He might have taken an advance. The contractor might have taken an advance by the customer. This is the customer, by the way, to make it a little more authentic. So he is supervising it, even he's not exactly supervising, seeing that the work is being done. So the fence is being put up. The supplier has taken an advance. He cannot recognize that. But as and when it's performed, let us say he has performed now quarter of the job, right? Then 25% of the total contract price into the total contract price can be recognized as revenue. Okay, and associated cost as well for that amount can be recognized on his income statement. So as and when it progresses, he's putting this fence, by the way, like this. Right? A survey is done, and based on the percentage of progress, the contractor can recognize income. So here, what is it? The customer controls. As the work's being done, because it's on his property, right? And thirdly, the other condition, any one of it, remember, for them to recognize it over time, right? The performance does not create an asset with an alternative use to the company. That means the asset is built to customer specification. Right? It's a custom built item that could not be sold to another customer. So actually, customer would be actually controlling the whole project because it's as per his specification. Right? In such cases, the company can recognize income, revenue, cost, etc. over a period of time. Previously, it used to be called percentage of completion basis. Now that term is no longer used. So for 2 and 3, what the customer controls, and there's no alternative use for the company, they can use it over time. The other one is, of course, over time as and when the customer is consuming the service. That is number one. Okay. Percentage of completion is no longer used. Instead of that, they use overtime. Now, when any of these 3 conditions are not satisfied, the customer recognizes the contractor or the seller recognizes revenue at the point in time. Previously, it was called completed contract method when all the performance obligations have been complete and the customer obtains control, and any of those three conditions which I discussed previously is not satisfied, then the seller has to recognize income at the point in time when customer gains control or the risks and benefits of the asset is transferred to the customer. Even if it takes more than a year, maybe 2-3 years. However, if a loss is estimated during the performance, if a loss is expected, that loss must be recognized immediately. They don't recognize revenue. They don't recognize cost. They don't recognize profit. It's all hidden in the balance sheet. It doesn't come onto the income statement until the performance obligation is over, right? This is for point in time. We'll come to the accounting entries later. However, if there's an estimated loss, right? Now, how do you determine that? The contract price we already know. Actual incurred cost to date will be known. This has to be estimated. So if the contract price is, let us say, 100, actually incurred is up to date is, let us say, 80. And in future, they have to, they will incur a cost of 30. So there's going to be a loss of 10, which should be recognized immediately. How do you recognize that, etc.? I will show it to you later on. The accounting entries would be done later. So what's the highlights of point in time? No revenue or profit is recognized until the performance obligation is obligated. However, an estimated loss when it becomes known, will be recognized immediately. Right? So journal entries will be done later. Then all this future, further topics here is to do with journal entries and the accounting. I would do that in the next session. So, but now you know the three conditions to account for it over time. And if any of those conditions are not satisfied, you account it in point in time, and you know the specialities of point in time. Nothing is recognized, but estimated loss is recognized immediately. So these are the highlights of both these methods of accounting for long-term contracts. We will do further concepts in the coming session. Hello, everyone. In the last class, I had explained about how to account for long-term construction contracts. And I also explained